A reinforcement of that soft landing narrative. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And we're not at a record yet when it comes to the S&P 500, but we're getting closer and closer. You take a look at the S&P 500 right now, currently up about 0.4%, slightly outperforming big tech. The Nasdaq 100 up about 0.3%. You take a look at the 10-year yield, coming down a little bit yesterday. Went up a little bit yesterday, but again, we're at some very low levels relative to where we have been. Still well below 4%, looking at 390 right now. And I did want to highlight dollar yen. Of course, the dollar weaker when you take a look at the Bloomberg Dollar Index, but stronger against the yen. That's, of course, after the Bank of Japan stayed flat yesterday, Romaine.
Yeah, I want to talk a bit about the dollar. I want to talk a bit about what we're seeing in treasuries, but let's talk about what's actually causing a lot of these moves. The economic data, it continues to roll in, and that economic data continues to paint a picture of a softer landing. U.S. new home construction among the latest data points across the wire. Construction of single-family homes in November, that was up 18%. To the highest since April of last year. Starts of multifamily projects were up about 6.9%, and the annualized pace of all new home starts combined, that stands right now at 1.56 million. That is now on par with pre-pandemic rates, and it suggests that the drag on GDP that we've seen all year long from weak residential investment, that might finally be starting to ease. Now, that economic data, combined with some dovish comments from Richmond Fed President Tom Barkin, refueling a broad market rally in the equity markets that is now in its 8th straight week, with most of the juice today coming not from big tech, but from the tangible links to the real economy. Think material stocks like cement and concrete company Eagle, today trading at a record high. Think freight companies like CSX, which is poised to close at a fresh 52-week high. Think real estate platforms like Zillow, which is set to match its longest win streak of the year. And think financials like Capital One, which is on its longest daily win streak in 21 years. Now, the repositioning of money around the more rate-sensitive and more economically sensitive sectors really should come as no surprise, Katie Greifeld, with the dollar down more than 4%, as you were just talking about. And, of course, that big drop in 10-year Treasury yields, benchmark yields, now a full percentage point below where they were about a month and a half ago.
And you add it all together, what we're seeing, of course, in the bond market, both in treasuries and in credit, you add in the dollar, et cetera, all of that is serving to loosen financial conditions. As you can see behind me, green means that we are in less restrictive territory. Red means restrictive territory. You go back, we're actually at the easiest levels since early 2022. You think about the hundreds of basis points of rate hikes that we have had between now and then, and it's quite significant. And still, we are easier and continuing to ease. But even still, you think about some of the unloved areas of the market that have been seeing a little bit more love recently. The Russell 2000, of course, comes to mind. You think about the tremendous move that we've seen in small caps. Take a look at this chart, though. We are potentially facing some resistance, this big run up that we've seen in the small caps. It's reaching a point at which previous rallies then failed. So we'll see, of course, as the calendar turns into 2024, whether this time is truly different or whether we will see this small cap rally run out of steam.
All right, Katie, great stuff here as we kick off the show, kicking you off to the close here on this Tuesday afternoon here. We got a lot to cover, including some of those key data points that Katie Greifeld was just talking about. We're going to have a discussion about what's going on in the M&A space and some great conversations ahead. Don't go anywhere. From New York, this is Bloomberg. All right, welcome back to the close as we kick you off here to the closing bells on this Tuesday afternoon. Victoria Fernandez joining us right now, Crossmark Global Investments Chief Market Strategist, to talk about some of the moves that we've seen over the past few days and weeks, Victoria, that all seem to be centered around this idea that not just is the Fed done, but more importantly, a revaluation of some of that revaluation we saw this year might actually be in store to the upside.
Yeah, you're right, Romaine. I mean, there's been this huge shift. We've had, what, 100 basis point drop in the 10-year since October when we were up around 5%, actually more than that, around 110 basis points. And so much of this predicated on the fact that the market truly believes there's going to be even more rate cuts than what the Fed has penciled in and their rate projections for next year. And I really feel like the market has gotten a little bit ahead of itself and really taken on this idea that not only is the Fed done, but they are going to cut quickly and many times in a row. I believe the market will probably have to undo some of the pricing that they have in there right now because I don't see the Fed cutting in March. And I think that just means we're going to have a little more volatility once we head into next year.
It brings up a point, though, about current financial conditions, which we've seen as a material easing. Even when you factor out stock prices, we've seen a material easing. And it's raised some concerns as to whether the market has gone too far or whether there are sort of financial conditions have kind of become divorced from what's most important now to the market, which is less inflation and more about the stability of the job market and economic growth.
It was very important to the narrative when rates were moving higher, and it was the story that financial conditions were doing the work. They were tightening and doing the work for the Fed, on behalf of the Fed, which meant we would have fewer rate hikes. And now that we're in the opposite side, it seems like that narrative is not there anymore. That connection between financial conditions and what the market is expecting has dissipated somewhat. You don't hear the story now that the Fed's going to have to hike more because financial conditions have loosened. And we've seen that pretty tremendously now. If inflation continues to come down, that could tighten things up a little bit. But it seems like for now, those loose conditions would be supportive of the consumer. We're going to have to continue to keep a watch on them as their household balance sheets have been weakening as of late and see if they can continue to buoy this economy.
And keeping the discussion going on the Fed, this line in your notes caught my eye, the fact that if you say that if the Fed is cutting rates, we believe it will be because the economy is weakening. That's really interesting because the conversation in recent days has really shifted to why the Fed would cut rates. And it seems like the broad consensus is that, OK, they're going to cut rates to get a little bit closer to neutral, to get out of this very restrictive stance. It sounds like you're taking the other side of that a bit.
I am, and really, I think the first question is where is neutral, right? What does that rate look like? And even Powell said in his press conference, they don't know exactly where neutral is going to be, but they have spent the last 18, 24 months trying to get inflation under control. And they have even stated that they would actually err more on the side of caution in keeping rates higher for longer in order to make sure that inflation did not rise again and become more entrenched than to let go too early. And so when we look at why the Fed would actually cut rates earlier in the year next year, to me, it would only be because they see recession coming on the horizon. There's a 75% chance of a hike in March that's priced into the futures market right now. And I just can't see that happening unless we start to see a recession. And I think that will be triggered through the labor market. And we're already starting to see some corporate layoffs be announced. So if we continue to see that and see the consumer weaken, then I think that might be the beginning of a pullback, a very mild recession.
That's what I want to get to. How do you position around that? Because if you think about the last 2 months, I mean, small caps just absolutely on fire. A lot of rate sensitive stocks, such as the real estate sector, for example, really leading the charge higher here. Is that short lived?
So there has been a tremendous amount of sentiment in the market. Normally we have it for the fourth quarter anyway, but because of the broadening out that we have seen in this rally, it's really been beneficial for all kinds of stocks. Like you said, small caps and mid caps actually outperformed large caps for a period of time there, and they're taking a little bit of a rest now. So because we think sentiment is and seasonality is going to continue to push this market higher, at least through the end of the year, we want you to be in the market. So we're not saying go to cash, but I think you have to be very careful in where you're placing your bets in the market if we think a pullback or a mild recession is coming next year. So we have some defensive names in there. You have some staple names in your portfolio, and balance it out with some of the tech names or some of the other growth names that you have. You want to make sure you're well diversified, have a little bit of fixed income allocation, have some options maybe in your portfolio to help generate income. So be very well diversified across asset classes and sectors.
All right, Victoria, always great to talk to you. Victoria Fernandez there over at Crossmark, helping to kick things off to the close here on this Tuesday afternoon as we round out the last couple of weeks of trading here in the U.S. and take stock here of the year that was. In fact, it's been the worst year for mergers and acquisition activity in about a decade. The value of M&A and related transactions is down roughly a quarter this year to about $2.7 trillion going into this holiday period. That would be the lowest since 2013. For more, we're joined right now by Michelle Davis, who covers mergers and acquisitions activity for us here at Bloomberg News. This is a pretty significant drop, though not necessarily unanticipated, given all the gloom and doom we had coming into this year.
Exactly. When I think back on this year and when I talk to deal makers, the one word that comes up is erratic. You know, it felt like the whole year, every time we would start to get some momentum in markets or in sentiment, something big would happen, like a bank would fail, or, you know, FTC would block a deal where there was no overlap, or there would be geopolitical tension. And so I remember hearing from, you know, bankers, lawyers that advise on deals that, you know, activity was there and then it would just fall apart at the finish line. And so it was just hard to get stuff over the line.
The big question, I guess, going into 2024, assuming that the market conditions are easing a bit here, are we just going to be talking about, I guess, new M&A type deals that make up the bulk of transaction? Or are we going to get some of those failed deals from this year and maybe even prior get pulled into 2024?
So, of course, deal makers are optimistic, and, you know, anytime you talk about the prospect of rate cuts or even rate stabilizing, everyone says that, you know, the M&A engines are going to get fired up again. And so I think we'll see both. You know, it'll be new deals, things that companies were reluctant or scared about pursuing this past year, and also a revival of some of the processes that failed last year.
And it's interesting to compare this current bout of doom and gloom and all this uncertainty to what we saw in 2020, 2021, because you have some great charts in your article, and you take a look at 2021, global deal values were $5.3 trillion. And if you think back to 2021, there was a lot of uncertainty then, too. What's different about this uncertainty versus what we saw in the pandemic?
Well, the biggest difference is that rates were at basically zero. Money was free, it was cheap, you could do anything you wanted, and the returns were always going to be there. You didn't have to do diligence. Now it's so much more expensive, and so that means it's harder to get things done. It's harder if you're, you know, an exec to convince your board that it's going to be worth it to put up the money, and it's harder to make the math work, frankly, on a lot of these deals just because of the cost of financing. But now that everyone's had time to get used to this environment, and if rates do fall, as you know, some project they will, that could make it all easier for next year.
Yeah, I think free money makes most things easier. But as you point out in the story, I mean, there were some deals that got done. You think about what happened in the energy sector, for example, just really in the last couple months. What were some of the success stories of 2023?
So, yeah, as you mentioned, there was a ton of activity in the oil sector. The two biggest deals of the year were the Exxon deal buying Pioneer and Chevron buying Hess. Those are both all stock deals, so the financing environment didn't impact them, and they benefited from their stocks going in the same direction. There was also a mega biotech deal. Pfizer bought Seagen for $42 billion earlier in the year. That deal just closed. They finally got the regulatory approval for that. And we saw a ton of activity across, the rest of mining, healthcare. Yeah. Tech was kind of not as busy as it has been, but there was the Cisco Splunk deal, which was about $28 billion in the fall.
Well, one hurdle that they're still going to have to deal with in 2024, I presume, are some of the regulatory issues here. Even if you have the money and the will to buy some of these companies, you have to be certainly a bit strategic. And we've heard that from some of the CEOs that have made deals, said that they really did sort of consider the regulatory issues before they actually put that in ink with whoever they were trying to buy.
Yeah, what we keep hearing is that companies are spending a lot more time on the front end thinking about their contingency plans and thinking about how they're going to approach the regulatory situation. So that might mean having a longer drop-dead date, or baking in reverse breakup fees, and having provisions that require them to say that they will go to court to fight a deal. One thing to look out for is, obviously there's an election in the U.S. next year. If there is a change in administration, that's something that some folks have said, could make certain deals easier. Obviously, we don't know how that's going to pan out, and it's may not impact the activity that we see leading up to that, but it's something to look forward to, I guess, afterward.
All right, Michelle, great reporting. Really appreciate your time today. Our thanks to Bloomberg's Michelle Davis. And of course, remain this big slump that we've seen in deal making this year has a lot of implication for banker bonuses, which I know we're going to get to later in the program.
Yeah, well, yes, implications. Yeah, that is correlation. We always talk about correlation, causation. Obviously, we know the correlation is there. If the deal flow is down, in theory, that's a smaller pie, I guess, for folks to share of.
People are getting paid less.
Now, what they do you think they like all get into a conference room and just like battle it out over the smaller piece of pie?
I would love to know. Maybe we'll get some insight on that in just about half an hour.
Yeah. You know who's done well?
Who?
Some of those trading desks did pretty well. I think
That's
their
true.
bonuses are going to hold up. It's just because the deal makers are missing out. I feel like the deal makers, they always get the lion's share of the bonus. Why can't the traders just have 1 year?
2023, the year of the trader. But coming up on the
side of the traders.
We're going to take a closer look at the impact of the Red Sea
whales.
attack on commercial shipping rates. That's next. This is The Close on Bloomberg.
All right, time now for a closer look at our global supply chain. The attacks by Yemen's Houthi rebels on commercial vessels out there in the Red Sea have really started to complicate those shipping routes. Some vessels are avoiding the Suez Canal altogether and taking long detours around southern Africa instead. The result is driving up the time it takes to get to destinations, and that's driving up shipping rates. Lee Klaskow over at Bloomberg Intelligence joining us right now to talk a little bit more about this. And Lee, I've seen this come up a couple times already this year. There were some issues earlier this year, still issues, persistent issues with the Panama Canal, and folks having to reroute because of drought conditions there. Now we have this situation in the Red Sea, which is intensified enough where shippers feel they just have to avoid this area altogether. What does that add to the time it takes for them to get from, I guess, one side of the globe to the other?
Yeah, if you're going to Europe, it adds another 7 to 10 days. The United States, even more than that. So it's obviously adding time, and time is money. And you're going to see freight rates go up. When we're talking about the container industry, we've seen rates go up around 10% over the last 2 weeks. That's, a good thing for the industry because rates right now are extremely depressed, and they're in loss territory for a lot of the carriers. So this is actually coming at a good time from the carrier standpoint. If we're just looking at the P&L.
At the PM, well, let's just stay on that topic for a second, because they also did well during the last big supply chain disruption, which was the pandemic. They did gangbusters. So when you say that earnings are depressed, is it relative to those gangbuster years in 2020, 2021, or you're talking about pre-pandemic?
No, we're talking pre-pandemic.
Oh, wow.
So they were creamy highs in 2021, 22.
That was like once in a lifetime.
Right,
profits,
exactly. Once in a generation. And now we're talking about rates that are significantly lower. They're around 29% below where they were a year ago, and they're over 80% below where they were at the peak. So we're significantly a lot lower than we were when it comes to freight rates.
So contextualize this in the context of the global supply chain, because it feels like we just got finished really with the narrative of the global supply chain still being snarled up by the pandemic. What is the state of the global movement of goods right now, and what does this mean for that photo?
I think the movement of goods right now is fine. What this is going on within the Red Sea, it's starting to complicate things. What you'll see is shippers looking to make sure that they are booking maybe ahead of time than they normally would. But just remember, there's a lot of slack capacity available on the ocean. So, maybe that T-shirt might not get to Walmart. It might take an extra week and a half. I think I can wait. I think you can wait. We might have to pay a little more for that. And depending on the goods.
Is it going to be relevant in a week, though, if it's like a Barbie T-shirt? you don't want that like 6 months from now. But point taken.
But it's going to add some inflationary pressures. But, I don't want to say transitory because people get in trouble for saying that.
It's a very loaded word.
Yes, but, we do think that these costs will be short term. And then when things, quote unquote, normalize, you're going to see freight rates come back down.
And how prepared are the shippers, the fleet owners for a situation like this? Of course, they travel through these waters all the time. They're very familiar with it. What does the contingency plan look like when you have a situation like this?
Well, I think they're waiting for the governments to get involved, which we've seen the U.S. government and some of its allies get involved. I think there was a group of 10 of them to make sure that the sea lanes are safer for ships. That could create convoys. It can create slower movement of vessels. But obviously, if you're saving 7 to 15 days of travel time, it's kind of worth those slower times going through the Suez Canal. But I think they're very much prepared because they can easily say, we're not going to go there. We're going to go south around Africa and add that extra time. So, I think they're very well prepared. And like I mentioned earlier, they have a lot of capacity on the market. The container liner industry is awash in capacity, and it's not supposed to get better probably not until 2026.
Interesting. Yeah, this is something I think we're going to be talking about for a long time, definitely through 2024. I do want to pivot from that. In addition to covering the shipping industry, you cover a lot of the domestic freight carriers, including names like FedEx. We are scheduled to get FedEx earnings a little bit later tonight. And I know this is a completely different topic than what's going on out there in the Suez Canal and elsewhere here. But this is a stock that has done pretty well this year, a stock that I think has surprised a lot of folks given the new leadership and the new pivot that they've taken. What do you expect to hear tonight?
Yeah, I mean, the stock's on fire this year. It's up 65%, I think. So it's done quite well. That's also based on a terrible year last year. So let's put that into perspective. What they're really doing is they seem to be executing on their plan. They're looking to save around $6 billion in costs over the next couple of years through their Network 2.0 and Drive initiatives. And that really what's doing is taking their ground and their express network and kind of seeing if they can work together as opposed to having just overlapping networks, trying to get synergies out of those networks. And also FedEx has been run as a quote-unquote fat company, if you will, and they're kind of trimming the fat, and so that should be good. And then FedEx also benefited from UPS when UPS had the labor negotiations going on with the Teamsters, so a lot of freight was diverted to FedEx because people were afraid that maybe there might be a strike at UPS. And it remains to be seen how sticky some of that freight is, and we're going to find out how sticky that freight is at the close.
Yeah, and just for some context, you mentioned FedEx's wonderful year, up about 63% at the moment. You compare that to UPS, down about 7.2%. And you hit on what I've been wondering about, basically that market shares, those customers that they've grabbed from UPS. What's your expectation when it comes to how sticky those new customers are?
I think some will be sticky, but most will not, because they use FedEx for a reason, and that could be cost, it could be service, it could be different relationships. I mean, FedEx has a LTL business, so it could be a lot of different reasons why you use FedEx. And a lot of shippers use both companies, and they just might divert back to FedEx. So I think that I think that FedEx would have won some of it, but I think a lot of it's going to go back to UPS.
All right, well, it'll be interesting to see what happens later tonight. Lee Klaskow, the blessed of Bloomberg Intelligence, covering the transportation sector for us, and we will have full coverage of those FedEx results a little bit later after the bell tonight. And Katie, as we count down to the bell, I'm actually kind of astonished that this rally continues. I mean, you can say, okay, yields are down, the dollar's down, maybe that provides a little fuel, but at some point the fundamentals have to catch up to this. It's
interesting too, again, we talk about very consistent gains. We're on what could be an 8th straight week of gains for the S&P 500. We're talking about very small moves though. It's been outside of the Fed meeting, more than 1% moves in either direction have felt a little bit rare.
But this is kind of what you want. I mean, this is the type of market that's typically healthy, right? Rather than getting, a 2% gain one day and then a 2% drop 3 days later.
What do they say though? Never short a dull market?
Well, yeah, it's a good point. Wow. Did you come up with that yourself?
I just came to
You should trademark that.
Yeah.
We'll be back in a moment. From New York, this is Bloomberg. This is the countdown to the close. Just about 2:30 here in New York. Looking at a modest rally in stocks, a relatively modest rally in bonds, and believe it or not, a bit of a modest rally going on right now in the energy space. Let's get right to Abigail Doolittle, who's standing by right now with our commodities close. Abigail.
Well, Romaine and Katie, we have some mixed action, as you can see here, for the commodities space. Overall, I believe it is a small, I'm not sure if the Bloomberg Commodity Index, if it's a small gain or a small loss, but it's a small move. But beneath the surface, these big mixed moves, crude oil hanging on to a gain up 1.5% as the Red Sea attacks continue to cause some panic among shippers. On the other hand, this is interesting. European natural gas, which you would think would be doing something similar or a bigger move to the upside, actually down 8.3%. And there are actually reports that LNG vessels have begun to reroute away from the Red Sea. Soybeans down 1.3%, apparently down for a second day in a row. Weather is improving, forecast improving in South America. More rain, that is good for soybean crops, so the possibility of more supply supply weighing on soybeans today. And then gold up 0.6%, Katie, despite the continued mixed messages from the Fed.
All right, Abigail, thank you so much. Now, still ahead, Odeon Capital's Dick Beauvais is pivoting to a more positive view on U.S. bank stocks. We'll talk to him about the reason why next. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Chewy, fetching a buy rating and a $27 price target over at Jefferies, which restarted coverage of the sector. Pet health, advertising, and delivery automation, some of the near-term drivers that make for a compelling risk-reward, according to the analysts. Those shares higher by 7%. Next, let's take a look at Amgen, which was upgraded to outperform over at BMO Capital. The analyst telling investors that Amgen has an underappreciated opportunity to take part in the obesity drug space without the premium of peers like Eli Lilly. Those shares up fractionally on the day. And finally, cruise lines rallying today after Citi raised the price target for several stocks in that sector. Royal Caribbean's price target going up to 148 from 133, with the analyst saying he's positive on the sector because of lower fuel prices and that persistently strong demand for sea travel. Shares up about 2.5% on the day, and those are some of our top calls. Let's stay in the sell side space and take a closer look at what's been going on with banks. Last week, Odeon Capital said it's turning more positive on companies like Bank of America, Wells Fargo, and U.S. Bancorp. An upgrade of 5 stocks after the Federal Reserve signaled it might cut interest rates next year. Analyst Dick Beauvais expects evaluations for those banks to increase. Pleased to say, Dick joins us right now to talk a little bit more about his call. Dick, this note caught me by surprise a little bit here. The upgrade that you have on these 5 names, which includes Bank of America, PNC, Truist, and a couple of others, is predicated on the idea that if rates, again, have peaked and more importantly are starting to come down, that does what to the valuations of these stocks?
Well, I think it dramatically increases the valuation. I believe that capital is the most important element in generating profit for banks. In other words, if they get $1 million in capital, they can leverage it 10 to 1. So now they have $11 million, and then they can go out and get 1% on that, which increases their earnings. Over the past 5 years, we'll say up till about 2 months ago, 3 months ago, banks had been, giving away their capital with stock buybacks. They had been seeing their capital reduced as a result of the increase in interest rates. And therefore, in 4 of the last 5 years, bank stocks went down, and they went down, of course, over the past 5-year period. Now, all of a sudden, for the first time in this 5-year period, you have a major change in the value of bank assets. We see interest rates go down, which means all of the assets that the banks have, because virtually all their assets are financial in nature, have gone up in value. So going back to that example, if you give $1 trillion or $1 billion to a bank, it leverages it 10 to 1, it makes 1% on it, and its earnings go up. So as interest rates come down, the value of bank equity goes up. As the value of bank equity goes up, the secular growth rate in bank earnings increases, and that means a higher PE multiple.
And Dick, is this a case where the positives of those falling interest rates outweigh the still potential negatives that are on the horizon for the financial sector overall, especially when it comes to Basel III, for example?
Well, the banks, when we step away from the mechanics I just gave you, banks are in deep trouble at the current time. They're in deep trouble because they're losing market share domestically very dramatically. They're losing market share internationally because of the bifurcation of the global financial system. So they're going to have a struggle to get back the market share that they've lost. And that's not being helped by the fact that the government wants them to lose market share as a result of this, end game, so to speak, Basel III end game. But again, that's the longer term view. The short term view is they have a lot more real capital, and with a lot more real capital, they should have higher PE multiples, and that's exactly what's happening.
I am curious that as we sort of try to see some of these executives execute on this idea of a more favorable environment, this then becomes, at least for stock pickers, a little bit less about just what's on the balance sheet, but also about how much confidence you have in the management teams. Obviously, you have some confidence in the 5 names that you upgraded here. Are there additional ones on there that maybe we should be keeping an eye on?
I think that bank managements know what they're doing. I think that they are dealing in a perilous environment. As I say, the money supply of the United States went from $8 trillion when, let's say, Brian Moynihan became the head of Bank of America to $23 trillion at the present time. The wealth of American households rose from something on the order of 80, the exact number is somewhere around 75 trillion to over 155 trillion at the present time. That's been a difficult environment for the banks because so much money out there has funded so many of their competitors, whether it's the capital markets arena, non-bank financial companies like, SoFi, for an example, that the banks are fighting to maintain their position in the marketplace. And I think that's going to be the biggest challenge going forward. But, bank managements, they're very smart people. They are really, people always look at banks and say, gee, they're behind the key on technology. That's not true. After technology companies, there's no group of companies in the world that spend more money on technology than banks do. And bank technologies is so far superior to that competitors that people would be amazed.
Yeah, you don't have to tell us. Anyone that could just take a look at the technology teams over at JP Morgan and some of those banks and just count up the number of people they have there. You'll get a lesson here on what really drives that business. Dick, always great to talk to you. Always wonderful insights. So smart. Have a wonderful Christmas and holiday season, and we'll catch up with you pretty soon, I'm sure. Dick Beauvais over at Odeon Capital Group there. And in just a bit here, we're going to hear from our exclusive interview that we had with the Bank of America Chairman and CEO, Brian Moynihan. David Weston had a chance to sit down with him just a couple of hours ago. We're going to hear what he has to say about the shape of the U.S. consumer and, more importantly, the shape of Bank of America. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. A little bit earlier, David Weston, the host of Wall Street Week, had a chance to sit down with the chairman and CEO of Bank of America, Brian Moynihan. It was an exclusive conversation where they talked about the year overall and the recession that never happened. Let's take a listen.
We just try to follow the data, and I think there were unexpected events. There are unexpected events in every year, and so whether it was the regional banking crisis early on in the year, or whether it was another, the Hamas attack on Israel on October 7th, whether it was escalation, a continuation in Ukraine, whether it's the tensions in China. These are all things that happen, and they go on all the time. But what we look at is what goes on in our core customer base, and we try to talk about what is going on as opposed to what could go on, and plan for what could go on. And that's been relatively strong. And our team, the spending continues even today at about 4 to 5% over last year, half the growth rate of 22 to 21, showing the consumer has slowed down, consistent with inflation getting under control, consistent with the Fed using the rate structure to choke off some of the activity, and it's happened. But overall, it's been a decent year, and the economy's grown, unemployment stayed low, and the bank's done very well.
Let's talk about the consumer. You are the largest consumer banking operation in the country. We are in the middle, toward the end now, the holiday season. What are you seeing there? I knew until now it was holding up pretty well. Where is it right now, the consumer, as of today?
Sure. So if you looked at it November of 23 over November of 22, and this is across about $300 or $400 billion a month of activity, customers spending money out of their accounts, that was up about 4.5%. So far in December, it's holding about the same. And again, that's about half the rate it was growing at last year at this time versus the year prior. And that's because the overall activity is slowing down. What's been interesting is it's broadened out to all things. There were these periodic things since the pandemic. First, people holed up and bought stuff for their house. Then they started to go out and travel some. Then they went to restaurants. Then they had another set of travel, different kind of travel, international travel. And then they got to concerts and things. That's all through the system. And now you see it spending kind of evenly across, retail stores are doing fine. Online sales are strong. They're all up 2-3%, flattish, 2-4%, depending on what it is. So everything's kind of normalized for the U.S. consumer and how they're spending money. They are in very good shape. They have money in their accounts. They're employed, and the wages are growing. It doesn't mean inflation didn't affect certain parts of the American public hard, but in general, when the unemployment rate's still in the mid threes to mid to upper threes, that is a very strong place for the consumer, but it has slowed down.
You say they're in good shape. That's what I was going to ask you. They're spending money. Can they afford it? What are you seeing in terms of their bank balances? I believe those have come down some. How fast are they coming down?
So it's a little bit of two different types of customers. For consumers that had a lot of excess cash, of course, when the rate they could get on that cash went from 25 basis points to 5% plus, guess what it did? It moved the market. So the very upper balances of consumer and our wealth management customers moved the market. But if you look at the consumers that the accounts are more the money coming in and out, they're still sitting with multiples of what they had pre-pandemic. So a cohort of consumers that had between $2,000 and $5,000 in their accounts pre-pandemic average about $3,200, $3,400. They're now still sitting with about $13,000 in their accounts. It has come down from a peak of $13,400 down to about $12,800. So it's come down a bit, but it's still much higher than it was before. And that's due to all the stimulus and stuff, and then holding on to that. Where they go next is going to be a more interesting question. They've slowed down their spending because things got more expensive. They slowed down their spending because they got a little bit more worried about their job. They slowed down their spending because the rates on car loans or all the things became more expensive. But they're still spending more than they did last year, and that's a decent setup for a soft landing.
Are you seeing any softness in consumer credit? I mean, are you seeing balances go up, delinquencies go up?
Well, balances have gone up on credit cards back to where they were pre-pandemic for us and the industry. And people are like, oh my gosh, and they're up above that even that. But if you adjust it for the size of the economy, they're actually still down. And so the consumer capacity to borrow is strong. Mortgages are all locked in at low rates. That the best asset for a lot of households is actually their low interest cost liability. It's mixing two different things on the balance sheet, but the reality is a 3% mortgage is an asset for people right now because it means their payments haven't moved. So that's good news. The home equity borrowings are down for us from 30 billion to 20-some billion. That means that they're not using that equity in their house, and there's more equity in their house. On the credit cards, the delinquencies are really consistent with the 19, and everybody says, well, it's back to 19. 19 was one of the best credit years in the company's history and the industry's credit history. So that's a very strong place. And so we feel good about consumer credit. And as long as the employment levels stay there, it's a little hard to believe that you'd have it. Now, lower FICO scores, you hear people talk about a little more noise, but the general consumer is basically a prime borrower, and they're doing fine.
What about the commercial side? You're very big in middle market, small and medium-sized enterprises. Is there loan demand? What's the sentiment there?
So, if you think about the consumer, we keep growing customers, keep growing households, keep growing this company. If you think about on the commercial, we keep growing customers, more logos, as our teammates call it, companies that we do business with, a record number this year. The thing about it is they're not using their lines as much. So the loan balance growth on the commercial side has been a little bit sluggish, a little bit flattish. Looks like it'll bounce around in low single digits this quarter. Now, why is that happening? Line usage before the pandemic for middle market clients was 40%, dropped to 30%, got back up to 36%, and then fell a couple hundred basis points. Why would companies borrow less at this point? They're worried about final demand. It's also a lot more expensive. So the Fed is having the impact, which is a loan that was like 3% to 4% is now 7 to 8%. People think about using it. So the line usage is down, meaning that they're not being as aggressive buying equipment or hiring people or extending inventories, mostly because they're worried about the economy slowing down. And when we say a soft landing, it doesn't mean the economy goes into recession. It says no. But what our team is saying, Candace Browning, the research team, is that we're slowing from almost a 4 to 5% growth rate to a 1% growth rate is still a major slowdown, and the business community is wrestling with that right now, trying to get that balance right.
Brian Moynihan there, the CEO and chairman over at Bank of America, talking with David Weston as part of our Wall Street Week daily segment. You can catch more of that conversation as well as a lot of other great conversations every Friday at 6 p.m. when Wall Street Week airs right here on Bloomberg Television. We do want to continue the conversation of some of the things that Moynihan was talking about, particularly when it comes to Wall Street bankers who are hoping for a rebound in some of those trader bonuses. But for things right now seem to be in a bit of a rut. Overall, traders took in 5% less in the first 9 months of 2023 compared to last year. Joining us for his perspective is Mike Mayo. He's Wells Fargo's head of U.S. large cap bank research, and he joins us right now. And there has been a lot of talk, as there always is around this time of this year, about Wall Street bonuses here. We know that there are some areas, particularly when it comes to deal makers, that'll probably be down. Traders seem like they might do okay. What does 2024 hold for some of these folks?
Well, I think what's interesting about 2023, and we just released a report today at Wells Fargo in the equity research department, that compensation might actually be a little bit higher for Wall Street pay, even while revenues are down. So a little divergence there, and like what's going on? I thought it's usually pay for performance, right?
So they're not really rewarding the people for performance.
What I think is happening here, and it's a balancing act for these Wall Street CEOs, is they need to show good results today for investors and people like myself. Let's see those profit margins while investing to preserve that capacity for the future in case that deal-making backlog finally manifests itself in 2024. And the word from pretty much all the Wall Street banks is they expect a better 2024, even though investment banking activity is about half the average level for the last decade. But we were in this spot a year ago, saying, okay, deal's going to pick up, and it didn't. And it feels like we keep waiting and waiting and waiting. And so it's a catch-22. Either they don't pay people enough now and lose market share if the calendar comes back, or they go ahead and pay people and the activity doesn't come back and said, why do you pay people so much? So it's they're really, balancing a tough situation.
It is a tough situation, and specifically if we want to link it directly to what Moynihan was talking about, a part of that interview, he talked about this idea of pushing more money into the trading side. Basically, that if they continue to perform, they're going to put more capital into that space and build out that business and go after market share. I mean, when you think of Bank of America, you don't always think of them as a trading house first. Is that going to become a bigger and more material part of their business?
Well, congratulations to Bloomberg for getting that tidbit today. The fact that Bank of America is expanding in their trading activities. My initial reaction is, wow, this is Brian Moynihan, the CEO, the person who's been so risk adverse to protect the franchise while executing very well. In fact, Bank of America in the Fed stress test has the lowest level of stress losses than any large bank. Now, having said that, there are questions, have they taken off too much risk? So they've given up some trading opportunities, and I think they're coming from a position of strength in terms of they want to lean in a little bit more. Right now, there's 3 dominant Wall Street players, and it does not include Bank of America. That's JP Morgan, Goldman Sachs, and Morgan Stanley. And then you have Bank of America and Citigroup. So perhaps Bank of America would like to get some of that share from those 3 market leaders.
Do you think it's possible, though, that they will be able to actually take share away even as they invest more?
Well, this goes back to the report that we released today. I mean, compensation is not exactly in line with the lower revenues, and it's because I think the Wall Street heads see more opportunity in the days ahead. And frankly, with interest rates rising at the fastest pace in 40 years and more volatility in the markets, that can create more trading opportunities. Also, the fixed income backlog. I mean, you have a lot of maturities and refinancing coming due and maybe new issuance, even at these higher interest rates. That can also lead to more trading. So perhaps Bank of America is telegraphing, hey, we're going to be in the game. We're going to be a player on the field to gain more share. And frankly, the big 5 banks in aggregate, including Bank of America, have over the last decade gained meaningful market share from all the other players. So the big 5 banks are Goldman, Morgan Stanley, JP Morgan, Citi, and Bank of America. They've gained a lot of share against the Goliath is winning is our theme. Those who are not Goliath have not done as well. So you can go down the list of all the European banks. So Bank of America and the other U.S. banks have benefited. Bank of America has not benefited as much as the big 3, and so perhaps this is their time.
I want to go back to the conversation on pay, especially as it relates to investment banking and deal making. I really like this line in your note from today that managements face the risk of both paying too little if activity rebounds and too much if it does not. What's the better problem to have at this juncture?
There's such a fear that if you pay too little and you lose your key deal makers, that when the deals actually come back, you're going to have trouble attracting them back. So I think I would like to see more of a surgical approach at these investment banks. So pay your key investment bankers and traders, but you don't have to make that across the board. So you want to make sure you keep your key people. And I want to see banks managing for sustainable growth and profit margins. So it's not one size fits all, I guess I'd say, by bank or even within the bank.
All right, Mike, it's great to see you. Really appreciate your time. That is Mike Mayo. He is head of U.S. Large Cap Bank Research over at Wells Fargo. Meanwhile, one paper company in China is scrapping annual bonuses altogether and is instead opting for a monthly cash reward based on how much its employees exercise. According to a local paper.
What? I'm sorry?
Well, listen here. If an employee could get as much as 130% on one month's salary in annual bonus if they've run at least 62 miles each month.
Stop.
62 miles.
This is rigged because you are a runner.
Yeah, I know.
So this benefits you. You probably get like 160% of your salary, and I'd end up with like 55% of my salary.
Yeah.
So this is weighted basically to the people who are already sort of die hard.
Yeah.
Working out. Is it just running? What if you lift weights or climb a mountain?
I'd have to
like
read
that.
the paper a little bit more closely, but it seems like it does benefit the runners. So
as somebody who's gotten a lot of bonuses and other things in other forms in cash, I always prefer cash.
Always prefer cash. There you go.
All right, still ahead here. We're going to cover the markets as we count down to the closing bells, rounding out into the final hour of trading here on this Tuesday afternoon. Romaine Bostick alongside Katie Greifeld. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
Katie, this is called a rally. It may not be the monster rally you're looking for. I know you want 2, 3, 4% gains.
Come on.
That's crypto type rallies.
It is.
Here in the equity markets here, 0.4% on the S&P 500, but you add that up over several days, Katie Greifeld, and when that's now entering an 8th straight week of gains here for the S&P 500. That's called compounding.
Yeah. And we are getting closer and closer to the record high, and that will be exciting. Not quite there yet. That is just below 4,800. We're getting ever closer.
Wouldn't that be a great sort of Christmas gift if we actually hit a record high before then? But you see here, too, there's the broadening out of the rally with the Russell 2000. We're outperforming once again, including the S&P 400 mid-caps here. And that's what you want to see, right? Those cyclical names and some of those rate-sensitive names really start to get a bid.
Yeah, that's where all the excitement has been. In the underappreciated parts of the market, that's what you're seeing now.
And you flip it up here, too. All this, of course, goes back to last Wednesday when the Fed basically gave us about the closest thing we're ever going to get to a mission accomplished banner. And you saw the big drop that we've seen in rates here. And that led to, look, I know you follow ETFs, right?
I do.
And I know you follow flows. So there you have it. This is the triple Qs here. And it's a weekly basis, a busy chart here. But you saw the big spike at the far end of your screen. That was the first weekly spike that we've had in about 4. And that's expected to even be higher this week once we get the latest data.
Yeah, and I love following the fund flows because it gets a real good sense of where money is actually headed and where the conviction is. But let's talk about some of the individual movers for today because there's quite a few of them. Some sell-side calls that you ran through earlier, but I thought this one on Amgen was really, really interesting. Of course, this coming from BMO, upgrading Amgen, saying that it has, quote, underappreciated potential in the obesity drug market. You know, typically you think about obesity drugs and Novo Nordisk and Eli Lilly come to mind. You can sort of get that upside without the premium if you buy Amgen. At least that's BMO's view.
Well, it's just got to get these things to market because right now it's AMG 133 and AMG 786, which last time I checked, we're still in development.
Exactly. The pipeline, the promise of the pipeline.
And they need like a sexy name there. They can't call it AMG, Mounjaro, Zepbound.
Yeah, Zepbound. They need a Zepbound type name.
How's Chewy doing?
Let's talk about Chewy. I love this call, obviously. Jeffrey starting off coverage with a buy rating.
You're an animal person.
I am, and actually we do use Chewy, but Jeffrey's view is that Chewy is the beneficiary of the rising average spend per household on pets. That is more than 60% since 2019 as owners really opt for higher quality food, treats, supplies. There are macro pressures out there, but they're less likely to impact Chewy, at least that's Jeffrey's
I never understood
view.
the negative sentiment on that. You know what my dog does? She'll literally sit on the couch. She knows we put the treats on top of the fridge.
Yes.
So she sits on the edge of the couch and just stares at that and whines.
My cat is the same way, except he can actually jump on top of the fridge. It's very scary. Quickly, let's talk about Affirm here. But BNPL self-checkout kiosks are coming to Walmart. Bloomberg Intelligence points out that that could propel volume in 2024. Affirm, of course, one of the big movers here on the day. Quite frankly, one of the big movers of the last few weeks as we move an hour away from those closing bells. Sit around. Our cross-platform coverage of today's top stories, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Tim Stenovic in today. Carol Masters still on vacation. And who else we got there? Emily Griffeo joining Tim today.
You never know until
Carol
the screen
Masters.
comes up.
I never
right?
know.
It's
Yeah,
gonna
I
be a
mean,
surprise.
they like to surprise me every day. They actually just leave the prompter blank, and I just try to guess who's going to be there.
It's all
But anyway,
ad-lib.
a hearty welcome to our
You guys get a
audiences across
teleprompter?
all of our Bloomberg platforms. They spare no expense here on Bloomberg Television. Tim Stenovic. I know you folks in the radio studio. What do you guys do
It's
over
all
there?
up here. I'm
Do
pointing
you
at my
even
head
get
right now.
microphones or what?
We got microphones.
Oh, you can see the microphones.
Yeah,
let me tell
we
you.
got
yeah.
microphones.
They're
We
very
got
prominent.
earpieces. We got a great crew too. Can't forget
You have
that.
glasses.
Hey,
You're not alone today, which
Speaking
I'm
of
glad to see.
speaking of sparing no expense, have you guys done your holiday shopping yet?
No.
No, Katie, really?
No.
None
We've
of it?
got days.
I don't mind.
Okay,
Not to
Romaine.
brag.
Romaine.
Yes, yeah, I'm done.
Okay.
Romaine definitely did it in like July.
Yeah,
I get those
he's
vibes.
kind of
I mean,
on,
it was
he's kind of on
September,
top of
but-
those
but
things.
point taken.
Well, I don't know if either of you are in the market for buying toys right now, but we talk a lot about deflation and disinflation. More about disinflation than deflation, actually. But we're actually seeing some deflation when it comes to the price of toys this holiday season. There's kind of a mixture of things happening right now. We're out of the pandemic surge of people staying at home with their kids and being flush with cash thanks to stimulus. So they're not buying as many toys. And as a result, we're actually seeing discounting. Also, the supply chains aren't snarled anymore. So why are you laughing, Romaine?
I'm laughing because obviously you picked this story because you've got two small kids.
Exactly.
I think Emily, Katie,
can
and
see
I are
right
just
through
sitting
me.
here like,
Very cool.
okay.
Poor Emily's
yeah,
been
that's
like
nice.
studying this story because she has no idea
Wow,
what
what's
the
that, a
kids
Gucci
want these
car?
days.
Yeah,
Who's
December
buying their kid a
Mattel.
Gucci
That's a
car?
nice
Hasbro.
Oh, that's a small car.
We're actually seeing price declines when it comes to toys. We've been documented
Oh, look at that skeleton.
so far this year.
I would buy
That one's scary. I don't want that one.
The
Hot Wheels.
challenges
It's like a
that
flashback to my
Hasbro and
childhood
Mattel
here.
have faced when it comes to layoffs and
gonna stomp her 4x4
reorganizations,
in
but
there and I'm good.
it's kind of at the end of the day the
Can
benefit
he
of
hear
the
me or not?
consumer. I can.
Oh, okay.
I can't
he
hear
just
you.
keeps talking?
But
I have
this
to
is
turn
a story,
I have to
though,
turn my
that,
earpiece up.
well, you remember Hasbro just
Yeah.
a couple weeks ago with those layoffs. This is a real problem, of course, for these actual toy companies, but great for the consumer, to your point.
It's great for the consumer that hasn't done their Christmas shopping yet because Mattel and Hasbro are slashing prices, and the toy promotion discounts are expected to peak at 35%, according to Adobe Analytics. So
Before Christmas? I mean, it's the 19th.
yeah,
Yeah,
I
Katie
mean,
hasn't done her
getting
shopping
that
yet,
last
so-
minute shopping,
Yeah.
maybe it was worth it to wait.
Well, I'm shopping on Amazon, I have to say, because the shipping is reliable. But if you're shopping on Amazon, be careful when it comes to the reviews. There's a really interesting story on the terminal about the AI product reviews are seen exaggerating negative feedback. I haven't actually seen this. Emily, you and I were chatting about it a little bit earlier at our desk, but apparently Amazon is using AI to convert all of the reviews into brief summaries that are just a few sentences. But the problem is that those summaries that are produced aren't exactly perfect, and they, in some cases, get the actual description of the product wrong, and the negative feedback in the reviews often is exaggerated.
So, first of all, kudos to the Bloomberg team that reported on this. This was fantastic reporting, but I couldn't help but think, I mean, who's still paying attention to these reviews? I thought we all knew they were either fake
I
or
think the
at
same
least
thing.
completely lopsided.
I read the reviews. Are you kidding me?
I never read reviews.
I
I'll buy
Absolutely
something on
read the
Amazon.
reviews.
I trust quantity of reviews.
Well,
if I see it has 1 billion 5-star ratings, I'm probably going to trust
Really?
it.
I think it depends on the
I
type
just look
of
for one 5-star
product
rating,
that you're.
and then I know.
For me, it depends on the
that
type of
was it
product that
enough.
I'm actually buying. I mean, when I kind of know what I'm going to buy when I go to Amazon and I just go and I order it.
You don't
So-
browse?
No, I don't browse. I don't necessarily shop. But there was some funny
Sounds
examples
joyless.
in this story that our own Spencer Soper wrote. The tennis balls, the Penn tennis balls, the best-selling tennis balls on Amazon, there were complaints that they smelled.
Oh,
Smelled like what? Tennis?
Tennis balls.
plastic?
And tennis balls have a distinct odor.
They
what about the
do.
bounce?
Can the AI pick up
That's-
the smell? Of
No,
the
but
tennis balls?
they comb the complaints there, and people, some reviewers have complained about smelly
Yeah.
tennis balls or the odor of these tennis
Yeah,
balls.
just soak them in the bathtub. That'll solve the problem.
That's how you ruin a good set of tennis balls.
Exactly.
That's the problem. Hey,
You know, if you hit them real fast, you don't really smell them.
that is true. Maybe people aren't playing as well as they should be. Guys, we got to go, but I guess I
Give my
know
best
that
to Carol. She looks
Katie
great
needs
today.
to. Katie needs to actually go and do some.
Yeah, I'm a
holiday
little
shopping.
busy. I'm booked.
Okay, hey, don't go anywhere because we'll be back again together live on TV, radio, and YouTube on Bloomberg Originals at 4 p.m. for Beyond the Bell when we take you through today's market close.
And we continue our markets coverage right here on Bloomberg Television. Counting you down to those closing bells, just a little bit more than 50 minutes until we get there. Right here and right now, joining us on set is Vanessa McMichael, Head of Corporate and Public Entity Strategy, Fixed Income Strategy at Wells Fargo. I hope got that title right here. I know all you Wall Street folks like to get all those titles in there, but great to have you here on the program.
Thank you.
And I want to start off here asking about something that's come up a lot, and that really is sort of the flight to cash that we saw in 2023, and whether we're going to see a reversal of that anytime soon.
Very topical question, Romaine. So this year has undeniably been the year of money market funds. Right now, money market funds are sitting at about $6 trillion. And to put that number into perspective, at the end of 2019, total money market fund assets were only $3 trillion. Only $3 trillion, right? It's still a large number, but we've since doubled. Year to date, there's been about $1 trillion in cash that has flown into money market funds throughout this year. Money market funds, you can't deny the value. So when you look at the curve has been inverted. And over the past couple of months, money market fund yields have remained stable, while the rest of the curve has yields have continued to decline.
I'm curious if you see that value proposition shifting at all to the point where you start to see people more comfortable with longer duration. The idea that if you're buying, cash, 6 months instruments or less here, there's obviously a lot of reinvestment risk in that. Yeah, you get 5% or whatever it is right now. But at some point, you've got to deal with a rollover risk. Obviously, you don't necessarily have that if you're buying a 5, 10, or 20 year. Is there going to be a market environment, an economic environment that makes that more attractive next year?
I love this question because this is like the topic for my conversations with corporate clients. So in my role, I'm helping corporate investors develop fixed income investment strategies that they're comfortable executing in-house. And so within that framework, despite the size of the company, the industry, we're solving for two goals: preservation of capital and liquidity. And so money market funds, they naturally fit those goals. And so money market funds are a very active investment vehicle for these sort of investors. But this conversation, we think that these investors do need to think about extending duration. We're seeing it even with the money market funds. So WAMs have doubled year to date because they get it. Every time the Fed is about to pivot and ease its policy rate, we see WAMs extend because they're trying to capture that yield. Now, on the flip side, though, to continue to answer your question, Romaine, in terms of the investor base, while money market funds are extending WAM, their yield, which are going to keep yields a little bit more elevated versus other front-end fixed income products, that's going to continue to add to the value proposition in money market funds. So no, I don't think we're going to see outflows in the near term, because once the Fed begins to ease, money market fund rates are only going to ease very slowly.
I want to talk a little bit more about that, WAM, because that's really interesting that even in money market funds starting to maybe extend duration a little bit. But does that get it all away from the core mission of money market funds? I mean, are the investors who are just reliably shoveling just heaps and heaps of cash into money market funds necessarily aware of that?
So great question. Money market funds, their goals are really, their investment goals are the same as the corporate investors that I talk to. So they're trying to earn current income by preserving capital and maintaining liquidity. So when I'm talking about extending WAMs, we're talking about going from 13 days to 34 days, right? It's relative, and they can only invest out to 13 months, at least those 2A7 money market funds where most of our corporate clients are investing their operating funds. So same exact goals, which means we're looking at a very defined list of fixed income alternatives that we even can invest in.
And just to be clear, when she says WAMs, we're not talking about the band. We're talking about average
weighted
maturities.
average maturities, of course.
That's my mansplation for you today.
I appreciate that.
No
Thank
problem.
you. So let's talk a little bit more about potential continued inflows into money market funds, because we're close to what, $6 trillion right now. And actually, Romaine and I had a really interesting conversation with Deborah Cunningham of Federated Hermes. That was actually at the end of November. She sees another $1 trillion coming into money market funds over the next year, really coming from the institutional investors. Does that sound right to you? What do you think we could see in terms of the magnitude of the cash bid?
Well, you know what's interesting is that growth that I shared about this just year to date in 2023, that's total assets, so institutional and retail. As next year progresses and rates continue to fall, I do think that there are a number of corporate investors already invested in money market funds. They have excess cash. We're trying to convince them to consider extending themselves a little bit, but I think money market funds are comfortable. Again, they check the preservation of capital box, they check the liquidity box, and they're same-day liquid. They're a substitute for bank deposits, which has been another really big conversation with the corporate investors I speak to because of what happened in March of this year. So, I can't put a specific number on it, Katie, but I would not be surprised to see more inflows into money market funds next year.
All right, Vanessa, a really great conversation. Really appreciate you stopping by on set. That is Vanessa McMichael of Wells Fargo. Now, coming up, we'll speak with Simon Freakley. He is CEO of Alex Partners. Why he says AI will not replace the need for human workers in the future.
And as the clock ticks down to the closing bell, a conversation up ahead with Sherry Paul, Morgan Stanley Private Wealth Management and Private Wealth Advisor, and we love titles here, Senior Portfolio Manager.
And what to watch in results from FedEx after the bell, and what those numbers might say about the outlook for the economy. All that and more coming up. This is The Close on Bloomberg.
Seven straight weeks of gains for the S&P 500 here on day 2 of the current week, setting up for what potentially could be an 8th. The sentiment certainly is there, and the technical lines certainly seem to be working in favor of those folks who remain bullish on this equity market. Some relatively strong data that we got this morning on housing starts, some potentially strong data that could come tomorrow and over the next 2 days when it comes to PCE and durable goods. And you overlay that over, I should say, with what we continue to hear out of Fed speakers, including Tom Barkin a little bit earlier today. More signs of dovish signals for 2024 ahead. That's put a bid under gold stocks. It's put a bid under home builders. It's even put a bid under oil and gas stocks as well. You have some individual stories peeling back on the day, like NVIDIA and Lyft, FedEx lower here on the day as we wait for their earnings. And then you have names like KB Home and most of the other home builders, not only at 52-week highs, but in some cases at all-time highs. That is the rally that has been unfolding over the last 2 months, with the big question as to whether it continues deeper into 2024. Abigail Doolittle standing by right now, hopefully to maybe answer that question with our Options Insight segment. And Abigail, you are taking a look at this everything rally and whether there are signs of it stopping.
And I wish I had that answer, Romaine. That's $1 trillion, a multi-trillion-dollar answer. To talk more about whether or not this incredible rally we've had over the last month, basically traders in November anticipating the Powell pivot. Let's bring in Matt Rao, head of portfolio management at Nomura Private Capital. Great to have you with us, Matt. And this rally, I mean, certainly has caught my attention just from the standpoint that from a technical standpoint, the charts, it didn't necessarily look like it was going to happen. It could happen, as it clearly has, as we went up into a range and then are starting to break through. Yeah. Overbought at this point. What do you see ahead?
Well, I think it's a lot of the market feeling good about what it wants to see. So what they're getting, what the market broadly is getting, is reinforcement to the idea that interest rates may be cut. Again, the dot plot shows 3, the market's pricing in 6. It feels a little bit like an impatient child at Christmas who sees a toy horse in the closet and has convinced themselves they're going to get a real horse for Christmas.
Yeah, a little bit overdone.
Yeah.
And relative to volatility, we've all been talking about how this VIX is 12, 13 for a long time, so somewhat suppressed. Is that a part of the reason why we do have risk assets just going higher and higher?
Yeah.
No fear?
Yeah, absolutely. I mean, the vol suppression that's coming from the yield generative funds that are selling vol for income are creating a risk signal for the rest of the market that uses volatility as an input for risk. And by that, I mean, when implied volatility is low, those risk systems will read the general risk as being relatively low as well. So I think it's a little bit of telling ourselves a story of safety that we want to hear, but I don't think it's driven on fundamentals.
Is that dangerous? Because as I think about it, everybody's been scratching their head this year about the VIX period, whether it's the zero-date options that expire on the day, or whether it's high yields on Treasury bills so that you can hedge a portfolio that way. But because of that circular nature, What was it a couple of years ago? The gamma.
The gamma effect.
Yeah. So in terms of like self-fulfilling, it seems as though it could really get overdone to the point where people could be taking the elevator down.
It can be, and it really, the analogy of a rubber band getting stretched is a very good one because there can be violent snaps when things are priced this low at the VIX, roughly 12.5. That implies very, very low level of movement and almost by definition a rally in the equity market. We've seen that since October 27th, since the market sort of hit its bottom, and the Russell is up over 20%. The NASDAQ's closing in, so is the S&P, and it's been a fantastic rebound. I'd be remiss if I didn't say, from a broader market standpoint, whether the Fed cuts or not, and I'm convinced that they will, I'm not saying that they won't, the accommodative action that the market has given to companies has already been tremendous.
Yeah, I mean, 6 cuts versus 3 cuts and pricing that through.
Credit spreads collapsing in the last month, vol coming down, equities higher.
And what about correlations? Because it's concerning too. You take a look at any of these signals and it just kind of gives it all clear. And this conversation reminds me that there might be some false security there.
Yeah, I think, implied correlation on the S&P is about 20. That's historically very low. And again, implied correlation measures the relative value of single name vol versus index vol. What it's telling you is that there's going to be a lot of dispersion. We've seen it coming into this point. We're likely to see it going into next year. And people shouldn't forget going into the holidays here that earnings season starts mid-January, and so we're going to start seeing the results of what's been going on in the last few months and see if the optimism is warranted.
Good point. And we do have PCE on Friday. It's going to
be
interesting to see if it comes in at that 2.8%. Great perspective, as always. Matt Rao of Nomura Capital. Thank you for joining us for Options Insight. And from New York, this is Bloomberg.
Well, New York City's ultra-lavish housing market is all but modest, with the top 10 most expensive home sales this year pricing in at a total $651 million. And it's really interesting to see where these actually were in the city. It turns out that 7 of the top 10 most expensive sales in New York City this year to date, there's still time left. They were on Billionaires Row. That, of course, is a stretch of 57th Street directly below Central Park in Midtown Manhattan. I think that's the one with that very tall, skinny building that everyone hates.
Yeah, I walk by that building almost every day here. I mean, there are people living in there, to be sure.
Yeah.
So I guess somebody's in there. I don't think it's full. But it gets to this idea, too, of sort of what can sort of withstand the ups and downs of, economic conditions. And to a certain extent, I guess, those sort of high-priced ones on Billionaires Row did okay, although they're also heavily dependent on foreign buyers, and we know that was always a big issue the last few years, of course, with Chinese buyers kind of being squeezed out for some reason, and of course, obviously some of the Russian and Eastern European buyers also being squeezed out.
Yeah, well, apparently someone has stepped in to buy these
Was
apartments.
that you?
It wasn't me.
Okay.
It wasn't me. And apparently there was a townhouse on East 71st Street
That's close to the office.
sold. I know. I was thinking that's probably a nice walk down to 59th Street, but no, it wasn't me. What's interesting when it comes to the trends here, again, it seems like Midtown Manhattan, specifically Billionaires Row, is very hot, and condos. Most of these were condos, so it seems like none of these ultra-rich buyers want co-ops.
Yeah, it's interesting, too, because when you look at the list, you see a lot of places that are in lower Manhattan, and we know that there's been that migration of some of the ultra-wealthy from the traditional Upper East Side enclaves and those nice townhouses that line the streets up here to downtown, which is a little hipper, I guess, and better restaurants. But I guess you have to trade in for a loft or something like that, I guess. I don't know.
Yeah.
And one thing I thought was interesting on here was they talked about the Plaza apartments. And there's been a lot of stories about how difficult it is to sell apartments in there and how some of those apartments haven't held their value, that if you paid, I don't know, $60 million for it a few years ago, you're probably going to sell it today for about $60 million and maybe even less.
Yeah, but I mean, it's just iconic even still. And you talk about the migration to downtown, you talk about the troubles with the Plaza, you lose the Central Park views.
Yeah, now I know you're a Midtown person. You don't go below 42nd, right?
No.
Yeah, it's dangerous once you get past 42nd.
I like to be
But there are some pretty cool places down there if you ever want to venture below 42nd, Katie.
That sounds so great.
They even have stables, horse stables down there.
This is The Close on Bloomberg.
This is the countdown to the close. I'm Romaine Bostic alongside Katie Greifeld. We're just about 30 minutes from the closing bells here in the U.S. and just about a couple of weeks from the end of the year. There's a lot of discussions about what happens in 2024 and what just happened here in 2023. AI, of course, has been one of the biggest buzzwords of the year, but how much will it actually disrupt the workforce? Let's get some insights out of Simon Freakley. He's the Chief Executive Officer of the global consulting empire firm AlixPartners, joining us now to talk a little bit more about this. And Simon, we know that when executives try to chart out, of course, the path ahead, they always have to look thematically. They have to look at what people are most interested in, whether it's their own clients, whether it's their investors, et cetera. AI, of course, took all the attention at the start of this year, and it looks like it's probably going to take a lot of attention heading into 2024. Are you hearing that from your clients as well?
Absolutely, hearing from every client. Of course, we were all sort of aware that in the distant universe there was this asteroid out there, a large language model, loosely known, and then we looked up one day when ChatGPT was released and saw this planet killer about to hit us, thinking, my goodness, it's going to transform every job in every company, in every industry, in every market. What does it mean for us? It's on the front of everybody's agenda.
Yeah, how big of a transformational technology can this be? Because we've heard so many extreme positions. This is either going to destroy us all or it's going to be the salvation that leads us to some sort of utopia.
Well, it's certainly going to be transformational. And what all of these big technology evolutions have shown us over the years, whether it's been the wheel or the plow or the printing press or the internet, is that what it does
That's some good company there.
But it's in that company, right? It enhances human beings, it doesn't replace them. So I think that what's becoming very obvious to every executive around the world is that AI is a way of enhancing their employees, a way of enhancing their businesses. It's a way of enhancing human beings, not replacing human beings. Now, the first thing they've looked at is how to use AI for efficiency. Can they reduce the number of jobs they need, the amount of real estate they need? But very quickly, they've pivoted into how will it drive growth? You know, every CEO with investors breathing down their neck want to know how they're going to grow. And AI is going to be one of the routes as to how they grow their businesses.
I think that's an interesting point, the idea of AI driving growth, because when you think about how most people talk about AI, it's how do we sort of take some of the grunt work out of analysts, for example? How do we increase productivity, free people up to do other things, and maybe it'll drive growth through that avenue because those people will have more free time. Is that the kind of growth you're talking about, or truly AI itself driving the growth?
I think a bit of both, honestly. I mean, if you think about what the manufacturing industry has been doing with robotics for the last 5 years, this sort of expression of cobotics, how you use technology and human capital to be even more efficient. BMW did some amazing analysis that showed that on average their shop floor employees were 160% more productive when they combined the human capital with the robotics. We're going to see exactly this with AI. So Microsoft's concept of Copilot, how we'll all use an AI Copilot to do some of the drudge work, yes, but also to accelerate and amplify the ability for human beings to create value in their roles, in their corporations, in their markets.
And when you think about the CEOs that you talk to, the businesses that you work with, you mentioned that everyone's thinking about AI, everyone's talking about AI, but how do they feel about AI? Is there optimism or is there an apprehension, a sort of, I'm scared of AI and what this means?
All of the above. So what we do every year, Kate, is we do a disruption index report, and we're just about to release this year's report in a couple of weeks' time. So here's a sneak preview. What the 3,000 chief executives have told us in the last few months that we've interviewed face to face is that the top 3 concerns they have are inflation and and interest rates. They're telling us they're concerned about what a combustible US election is going to do to their businesses and their markets. And they're also concerned about the wholesale disruptions that are going on within their businesses. When we ask them about their biggest opportunities, number 1 is AI. So comprehensively, people are looking at this as an opportunity, not a challenge. And they're right to, because when they're looking for new avenues for growth, new avenues for value creation, new ways of, in a workforce where it's very, very difficult to get enough of the skills that one needs to drive an enterprise, AI can be the unlock. So more opportunity than challenge.
I do want to talk about, though, some of the challenges, and you laid out a couple, including some of the geopolitical issues that have transpired really over the last few years, whether it's the trade relationship with China, whether it's the wars in Israel and in Ukraine. Going into 2024, are these executives feeling a little bit more optimistic about a resolution of some of those issues?
Well, I mean, both of the examples you gave are just appalling human tragedies, aren't they? These two wars that are happening. I think it has made people incredibly anxious, and I think there's a slightly different temperature in Europe than there is in North America. In Europe, I think the profound disruptions that have been caused by those events, compounded by the many other disruptions, have meant that supply chains are still a challenge. How do you plan for just in case, not just in time? How do you make sure you're not a hostage of a global supply chain or even a regional supply chain? How you have alternatives? In North America, I think literally in the last few weeks there's a sign of rising optimism that actually people don't think we're heading to a recession, that maybe things are going to be better than we thought. And despite the backdrop of what could be a very challenging electoral year, that actually maybe things aren't so bad. So I think there is rising optimism, but acute competition in most markets, and people are looking for the eddies in the stream to drive value and drive shareholder return.
People are also looking for, I guess, a little bit of stability or continuity as well. You mentioned, obviously, we have a contentious election here, and depending on who gets elected here in the U.S., that could really reshape the regulatory and legislative landscape in a way that we haven't seen in some time. And I know executives don't really have a lot of control over that. I mean, they can lobby and try to make their case heard, but they still have to position around it. Have they started to do that, or are they waiting for the outcome before they react?
They've absolutely started to do it, Romain. So they've actually looked at, what are the different scenarios they need to manage for. Not necessarily that the electoral outcome will be a big defining issue in that, but how do they plan for the future? A big issue, of course, is US-China relations. So in an electoral context, what does it mean for the US in an environment where people are talking about decoupling? Interestingly enough, it's one of the few things where the left and the right seem to have a common narrative, the challenge of China. But we shouldn't forget that China's manufacturing GDP is greater than the US and the European manufacturing GDP added together. Any thought of decoupling from China is fanciful thinking. So what we need is a common sense narrative that says, how do we work in a world that's maybe not as global as it was, but is certainly intimately connected?
So it's not realistic for business leaders to think that they can decouple from China. But to bring it back to Treasury Secretary Janet Yellen, she said over the summer that the U.S. needs to de-risk but not decouple from China. Maybe you can't decouple, but should business leaders be thinking about de-risking?
Well, absolutely. So not be a hostage of any one strategy. So there's always a narrative, of course, should Apple carry on making its products in China? Of course, they've already started to make products elsewhere, Vietnam, for example. But people forget, 20% of Apple's global sales are in China. 40% of Volkswagen's global sales are in China. So it's not just that China is the shop floor of the world. They're also increasingly a very, very important consumer. So to Janet Yellen's point, decoupling is not a realistic possibility, but how do we establish a way of doing business together where people don't have to worry about their intellectual property being stolen, they don't have to worry about how business is done, but honestly, any thought of decoupling with China is just a nonsense.
And I mean, broadening this conversation out from just China, of course, the concept of onshoring, of nearshoring, supply chains, other parts of the business in the wake of the pandemic and all the snarls we saw there, that was definitely a big part of the conversation over the past couple of years. Right. In 2024, is that still part of the conversation, or are people more comfortable with their global relationships?
Very much so. So for the first time, maybe ever, the US now imports more from Mexico than it does from China. So there's already been a shift. For the first time in many years, the median income in the US is going up. So we're seeing wage pressure, compressed margins, people having to look for opportunities to preserve margin and grow margin. So how they source their product, how they make sure they're not a hostage of any one strategy, as of course so many of us found out in the pandemic was critical. All of these themes are going to continue in 2024 with this additional big question: how are we going to use large language models, how are we going to use artificial intelligence to enhance what we do and accelerate what we do? AI will be a force multiplier for human beings. It won't be a replacement for human beings.
All right, Simon, that's a great place to end it. Great to speak with you. Really appreciate you stopping by. That is Simon Freakley. He is AlixPartners' Chief Executive Officer. Now coming up, it's the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. All right, time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. Joining us now, Scarlett Fu. Scarlett, who are you watching?
So I'm watching Jimmy Lai. He's the former Hong Kong media mogul, now activist, and I'm not the only one watching him. The UK government is monitoring his national security trial taking place in Hong Kong and demanding consular access to the 76-year-old who is a British citizen. We know that the judges are expected to deliver their decision on one of the charges on Friday, and the US, the UK have been pushing on Beijing to release Lai.
Yeah, I almost forgot about him. I mean, he's kind of been out of the context for quite some time here. Definitely an interesting story here and a very critical one here for the future of Hong Kong and China. Back here in the U.S., I'm keeping an eye on none other than Carl Icahn, of course, the legendary billionaire investor, slashing his company's quarterly payouts in half and renegotiating some loan terms. This is in the aftermath of that Hindenburg report that had sent the shares plunging a little bit earlier. Remember, there's been a lot of talk about Icahn Enterprises, which has effectively been like the family, the vehicle for his family business here. But there have been a lot of concerns about conflicts of interest and whether the whole setup of a public company that was effectively kind of set up, let's face it, to kind of funnel money and profits back to him and his family, whether that was done in the most upright way. Hindenburg said no. Icahn, of course, said, you know, mind your business. And I guess at some point the regulators will figure it all out.
Yeah, there you go. And of course, 2023 was a huge year for Hindenburg Research, too, if you think back also about their bets against Adani as well. But let's move on and let's talk about Mark Liu. He is the Taiwan Semiconductor chairman. He's planning on retiring in 2024 and ceding his role to the current CEO, C.C. Wei. Now, this marks a power shift at one of the world's most important chip makers. Of course, when you think about them leading the industry, the business and the industry really through a global chip glut, some really difficult times. And of course, this is Apple's chip making partner as well.
Yeah, and Liu has been the public face of TSMC since he succeeded the founder of TSMC, which is Morris Chang, back in 2018. So the Liu and Wei team is over. It's now just the Wei team on its own.
Yeah, and he's been co-CEO for a while, right?
Yeah.
And I thought that was interesting, too, because they were talking about how instrumental he was in this whole packaging business, which was something that I kind of only got hip to earlier this year, about how that's really kind of the next big thing, particularly when it comes to these higher power chips and AI. That packaging business has a potential to be pretty lucrative. All right. Well, those are three other folks that we're taking a look here at on this Tuesday afternoon. Also keeping an eye on the markets as we move closer to those closing bells. Sherry Paul, Morgan Stanley Private Wealth Management Advisor and Senior Portfolio Manager, joining us in just a bit. This is Bloomberg. This is the countdown to the close. Romaine Bostic here alongside Scarlett Fu as we count you down to those closing bells. Just about 10 minutes to go, Scarlett, here. And look, it may not be the sexiest rally in the world, but it is a rally, 0.4% on the S&P 500, and big outperformance when it comes to the small caps.
Yeah, and we're all on record high watch with the S&P 500 inching closer to its all-time high of 47.96. I'm also all on small cap watch because that group is up more than 2%. Home builders, notable that all 17 home builders in the S&P 500 indexes or S&P indexes are higher after housing starts unexpectedly climbed. I guess lower mortgage rates is encouraging people. And what's notable, Romaine, is the lack of movement in the Treasury market. I mean, we're talking about 0 to 1 basis points move across the curve.
Yeah, absolutely. Maybe a little bit of steam has come out of that rally here, but I think people are just waiting. Don't forget, we got some big data this week still ahead.
PCE will be a big one.
So it'll be interesting to see whether that changes the narrative or maybe everyone is just gone for the holidays already. Don't say it. All right, Sherry Paul joining us right now, a Christmas treat for us here. Morgan Stanley Private Wealth Management, a private wealth advisor and senior portfolio manager. Sherry, always great to talk to you here. And let's talk about, I guess, about the shift in sentiment, because it has been pretty material over the last few weeks. I mean, 6 months ago, everybody was still talking about recession. They were still looking at that rally and saying, there's no way this can last. And here we are. I mean, this is going to shape up to be one of the better years, all things considered.
Yeah. Look, I love a good mental shift. You know, it's never the wrong time to start thinking the right way.
Yeah.
about opportunity and the markets and innovation. And this, I think, I've said this before, I think we're in a very seminal moment where we're deglobalizing and reglobalizing at the same time. But the centerpiece of that is innovation, and what I'm referring to as a cost reduction bull market within the equity markets. And so you wrap all that together, and thematic investing now is going to win the day, along with disciplined sector weighting, active management, and single security selection around companies that show tremendous leadership around margin reduction and innovation.
I have to ask you, though, and I've been asking pretty much all our markets guests about this, and the idea of that sort of so-called cash on the sidelines. Just a little less than an hour ago, we had someone on. We were talking with her about all the money in money market accounts and whether, A, that shifts outside of money markets, whether it comes back into equities or into other areas of fixed income, or whether it just kind of stays put in cash or cash-like instruments, as there's still maybe some fear out there.
I really hope that it comes out of cash, or at the very least, you can extend into short and intermediate fixed income, just based on the idea that we will likely see some kind of Fed cutting at the end of the year. So I'd love to see investors secure that income for their own portfolio well-being, and to see it come into areas of the market that were woefully underrepresented, like healthcare stocks and staples underperforming. This past year, I think, present a great contrarian opportunity, good dividend yield, and growth at a reasonable price. And so that would be my hope. I mean, I think whenever we see the cash levels that we did this year, as a portfolio manager, it kind of pains me to see it, because mentally where people went, so different than where the market went. And what we want to be doing as investors is moving out of sort of this painful paralysis into prosperous thinking, because that's where opportunity is. And the whole point of investing in the market is to improve your capital position. And so we got to start with people improving their mental capital, and then we can move into the money capital.
Yeah, but we're all, when it comes down to it, worrywarts and stressed all the time. I feel like this year's gains were against a backdrop of hand-wringing. Everyone was worried all the time. Once you take out AI, the weight loss drugs, and of course the Fed pivot, it felt like markets were constantly climbing a wall of worry. What's at the top of your clients' worry list heading into 2024?
Well, it's such a good way to put it, because the markets climbed the wall of worry, but most investors didn't. And that's the key, right? This is where kind of old truths and new truths collide. Old truths of rebalancing portfolios, staying committed to asset allocations, and reinvesting in volatile markets, is set within the backdrop of new truths, which is we're deglobalizing and reglobalizing at the same time, which is a big psychological world pivot, and that's where the hand-wringing is for investors. It's squarely, for my clients, it's geopolitical. And so we want to decouple what I refer to as like the policy volatility, though, from the potentiality of investing opportunity. And remember, I'm a portfolio manager, so my responsibility is to find the corridor of opportunity for good money outcomes in all weather conditions and all economic conditions. Over the last 25 years, I've been doing this, and this is a classic head fake setup for a lot of people that I'm really trying to encourage them that we can address that kind of worry, but don't have it manifest in your money outcomes.
So there are sector preferences of healthcare, of defensive, of some selective tech name.
Yes.
That happens regardless of who wins the White House, how contentious that whole political battle might be.
Oh, definitely. Innovation is agnostic of party politics. And that's the exciting thing about the capital markets, which I find to be really like a refreshing place to find reprieve from all of the hot air out there, frankly, because we can live in the numbers and the math and science of PE ratios and outcomes and betas and all the statistics, which can become a big passion sport, frankly. When there is, so much that's being said in the world that doesn't necessarily land as being true. But we can find truth in the profitability of companies and ideas. And I think that we're going to see a lot of that opportunity in 2024.
That's well said. And honestly, that's one of the beauties about, I think, what we do here. Certainly one reason why I chose this profession, because it does give you a way to sort of look at the world without sort of dealing with some of the noise that I think consumes us on a day-to-day basis. It gets to the idea, though, and you use the word all weather, the idea that you have to basically construct portfolios for all weather conditions here. Have you seen a material shift in the way you have to do that over the last few years, or is it still kind of generally the same playbook?
Thank you for that, because yes, and that is that I've been a lot more active in the portfolios than I've ever been. That's different than shifting asset allocations, far more active in the geography, the market cap, and the sector weighting. overall in terms of how we're overweighting and underweighting sectors as the economy kind of shifts. And again, the U.S. economy is shifting within a global pivot as well.
Yeah.
And, so that's the place that we're really, I'm taking a lot more activity than I ever have in 25 years, frankly.
Do you think the conversations with clients in 2024 are going to be easier than the ones you had this year?
I think they're going to be the same. I think we enter into much the same. We have geopolitical instability, uncertainty. We've got 2 hot wars. We've got, now a Fed pivot the other direction potentially. All the same kind of conversations and narratives. It's sort of like we're in a loop in a way. And so, again, my conversation is going to be, that's fine. However, here's the corridor of opportunity, and it sits within finding out-of-favor companies that are doing great things in a way that we can make money for clients. It's really that simple. There's more I could say about that, but another time.
Yeah, I think we're going to have to leave it there. Sherry, it's always wonderful to talk to you. Always wish we had more time. And wishing you a very wonderful holiday season if we don't talk to you before the end of the year. Sherry Paul over at Morgan Stanley Private Wealth Management, helping us count us down to those closing bells. We're just about 2 minutes away from those closing bells. Sit tight. We have full market coverage coming up right here on Bloomberg, including coverage of those results out of FedEx as we take it to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell and here to help take us beyond the bell. It's a global simulcast with our friends Tim Stenovic and Emily Grafale. Emily filling in today for Carol Masser. Welcome to our audiences across our Bloomberg platforms, television, radio, and our partnership with YouTube here on a day where that rally, Tim Stenovic, in U.S. equity markets continues anew.
Yeah, I feel like a broken record here. I mean, over the last 7+ weeks, we've seen consecutive gains for the S&P 500. If you go back to October 27th, Emily, kind of the bottom of, not of this year by any means, but the bottom over the last couple of months, the S&P 500 is up more than 15% since then. That's a huge rally in a really, really short amount of time.
Yeah, and it's interesting to see, even though yields aren't moving down that much, they're pretty much flat today. It hasn't stopped the equity market from rallying. And even those parts of the market that were perhaps more unloved earlier in the year, the Russell 2000 up almost 2% today, Scarlett.
Yeah, and it's notable, too, that with the Russell outperforming, volume in the Russell 2000 is up 9% from the 20-day average, while volume in the S&P is down 15% from the 20-day average for today.
Yeah, absolutely here. And obviously, we know heading into these, what is effectively the last week and a half of trading here on the year, volume tends to start to taper off a little bit. So take the price action with a grain of salt. But nevertheless, the rally that's unfolded here over the last 2 months, at least for right now, appears to have some degree of staying power. We are getting the closing bells here in New York on this Tuesday afternoon. Let's walk you through the numbers as we wait for them to settle. Of course, as Scarlett pointed out a little bit earlier, we are on watch for a record high on the S&P 500. Not there today, but 4768 and change is where we're going to close at today here. So just what, if I do my math right, we're about 25, 30 points away from that all-time high here, up about 0.6% here on the day. The Dow Jones Industrial Average also at record levels, up about 256 points or 0.7%, while the NASDAQ Composite closing at that 15,000 mark, up on the day by about 98 points or 0.7%. But let's talk about the star of the show here. For a fourth straight week here, it looks like the Russell 2000 is setting up to outpace the rest of the broader market. A 2% gain here on the day. Of course, at best, both the NASDAQ, the S&P, as well as some of the other major indices here as people rotate, guys, into some of those small cap and cyclical names. And
even if you look at the S&P 500, you see that it was roughly a 4-to-1 ratio for stocks that moved higher in the S&P 500 today. 399 advancing, 101 moving lower. Actually, a bigger ratio of advancers on the Dow today. 23 moved higher, Scarlett, while 6 ended the day lower.
It's similarly
Are there only 30 in that?
I don't know why. Is my math wrong here? I'm seeing 23 and 6.
I mean, that comes to, let me see, 1, 2, 3.
Yeah, 30.
Yeah, it's carry the 1. Yeah, it's 29.
So what are you seeing? Same thing?
No, I see 30.
Oh, okay.
But there you go.
Hold on, let me refresh the screen here.
Hey, let's pause the show while Tim can
I'm still
whip
seeing
out his
23 and 6. I don't know what's going on.
Well, the math here is pretty simple when you look at the industry
I'm going to
groups.
send you a screenshot to prove it.
Scarlett, can you save one for yourself?
Yes, let's save Tim here. 23 groups out of 24 in the S&P 500 in the green, led by autos and components, energy stocks, and consumer durable and apparel. The only group to finish lower is commercial and professional services, and that's just fractionally lower.
I'm going to help Tim out here.
I'm still sending a
23
screenshot.
stocks higher, 6 stocks lower, and 1 unchanged.
Oh, there you go.
You got to pay
alternative.
attention. That 1 unchanged. Procter & Gamble doing nothing.
Oh.
Yeah,
okay.
1.8 million shares
You know
swapped
the
hands
problem?
and the shares went
I was
nowhere.
carrying the 1.
Okay,
You said
that's your
carry the 1.
problem.
Yeah,
Always
that's my
carry the
problem.
This
6.
is why we're journalists and not doing the number crunching.
Let's see if I got the colors right, the green versus red today, okay? So let's talk about some of the notable gainers. The best performer on the S&P 500 on a percentage basis today, Enphase Energy, nothing like some significant layoffs to get investors excited. We learned after the market closed yesterday the company will cut its workforce by about 10% and also close 2 contract factories to reduce costs. This coming amid a slowdown when it comes to rooftop solar. We've covered that really closely over the last few months. These reductions will affect about 350 contractors and employees. That's according to the filing that came out yesterday. Enphase also set to shutter contracted operations at Wisconsin and Romania sites and, quote, resize other contracted sites, finishing the day higher by about 9% today. Moving on to Meta Platforms, the best performer on a points basis in the S&P 500 today, higher by 1.7%. Meta hitting a 52-week high today. The company actually only about 8% off of its September 2021 highs. Should note that UBS did name Meta a top pick for 2024. And then buy now, pay later stock Affirm, seeing a real surge today, higher by close to 16%, finishing the day 15.5% higher. This after the company said that it'll bring its pay over time options to self-checkout kiosks at over 4,500 Walmart stores in the U.S. I know it's good news for Affirm, but if people are using buy now, pay later when they're checking out from Walmart, it kind of raises some antennas for me about what exactly it means for the economy. And if people are not able to afford basic necessities outright, then what does it say about the power of the consumer, Emily?
Yeah, that's right. I mean, for the decliners here, I'm looking at one very, very large cap stock and then also 2 small cap stocks. But I'll start with NVIDIA because that was down as much as 1.6% or 1.6%. Edgewater Research noting that this is for the first time they're seeing AI and GPU demand mixed at the semiconductor giant. They still said, though, that the long-term prospects of the company's data center demand remains strong, and they reiterated their neutral rating on the stock. It's really hard to find anyone on Wall Street who is super bearish about NVIDIA. We'll see if that changes, though, as we head into the new year. On the smaller
Is there
cap
someone
side,
on Wall Street? Wouldn't they lose their jobs if they were bearish on NVIDIA right now?
Yeah,
Okay.
we will see. I don't
It's
know.
like when Michael Pachter was the only analyst that was bearish on Netflix, and he was wrong for so many years until he was right a couple of years ago. Yeah.
If you wait long enough, you'll eventually be right. Isn't that how it works?
Yeah, broken clock.
CureVac also dropping a big loss today. Actually, not their worst on record. This was the worst decline since 2021 when they fell 50%. Today, falling as much as 41%. Germany's patent court ruled that the company can no longer rely on its mRNA technology patent in its litigations against competitors in German courts. That was a large decliner on the day. And I'm also looking at Unicor tumbling 15%. They gave a disappointing interim data update from early stage trials of their AMT-130 gene therapy. A lot of biotech stocks. Mizuho downgrading that stock. Their price target was 52. Now looking at a price target of 10.
Yeah, and that CureVac drop, that has to be probably one of the biggest disappointments coming out of all the big companies that were supposed to benefit from the COVID pandemic. Let's take a quick look at yields here. I mean, it's not a whole lot to look at, which might be a bit of welcome relief given the volatility that we normally see there here. Basically, we did see a shift down in the curve, but we're really talking about 1 basis points across the curve, and calling it 1 basis points is actually a bit generous here. Now, there was a little bit more volatility in between all that, but you put it all together, at least for right now, people seem to be comfortable with where yields are at right now, but there's still a big debate right now as to what the next move is. 3.9275 right now on a 10-year yield, with a lot of big bets here that can go significantly lower over the next few months.
You think the bond market is finally listening to these Fed officials who are pushing back against what Powell said last week? Nah.
No. I don't know. Less so than the equity market. I mean, more so than the equity market, I should say. But I don't know. It seems like everybody's ignoring any comment that happened after last Wednesday.
Yeah. All right. Well, we are in the midst of earnings season. We are getting results crossing the wire right now on FedEx. A knee-jerk reaction in the stock market, pushing the shares down here in after-hours trading as the company reported fiscal second quarter numbers that actually did meet analyst estimates here. Revenue coming in at $22.2 billion. The street was looking for 22.4, so a slight miss here, but we're only talking about a few million here and there. Operating income coming in a little bit light as well, 1.42 billion versus a street estimate on average of 1.49 billion. But the company is standing by its full year forecast, saying that it expects to see adjusted EPS in that range of $17 to $18.50. That was the range that it had given prior to today, and the street was looking for $18.22. So still a holding out hope here for the street that they will get those numbers. FedEx also saying that it expects to add to its buyback program and added $1 billion of buybacks during fiscal 2024.
And here might be why the stock is moving lower in after-hours trading. Adjusted operating margin, 6.4%. Analysts were looking for higher than 6.5%, 6.6%. So the big story here for FedEx is it's really about higher earnings on lower sales because of cost cuts in the ground unit. But if your margin is not expanding, then you're not necessarily getting it done.
And I'm curious, we spoke with Lee Klasko on Bloomberg Television a little bit earlier, who talked about the cost story here. And I do wonder when we start to actually see that reflected in the margins and in the bottom line numbers.
Yeah, we'll have to see. I mean, FedEx is up 64% year to date, outperforming the S&P 500. So we'll have to see how this actually plays out in trading. And we talk about the sell side, 21 buys, 15 holds, 0 sells on FedEx as we head into the holiday shipping season.
Yeah, the big question going into this print was certainly to what extent did FedEx benefit from UPS's negotiations with the Teamsters Union earlier this year? The customers that they pulled over from UPS, are they actually going to stick with FedEx? I'm certainly going to be some questions about that on the company's earnings call a little later.
Yeah, and of course, the previous quarter, it also got a boost from the failure of Yellow. So it's at the expense of its peers or its competitors. But what everyone wants to see is that revenue growth, the driver for revenue growth going forward.
And just on that note, too, Lee Klasko said that, to answer your question, Tim, he does think that benefit that they got is temporary.
All right. Well, we're going to actually be speaking to Lee in just a few minutes also over here to get his reaction on these numbers. So stay tuned.
We warmed him up for you.
You guys got the preview, you know. Yeah.
So where's Carol, by the way? I know she went on vacation, but wasn't she supposed to come back and work?
Send her a text.
Okay.
Yeah, send her a text. Okay. Hey, what did Procter & Gamble do today, Romaine?
I believe, Tim, last time I checked, it is one of the 30 stocks in the Dow Jones Industrial Average that did nothing.
It did nothing. Okay, there we go. Hey, that is going to do it for our Beyond the Bell coverage this afternoon. It's our cross-platform coverage of the market close on Bloomberg TV, on radio, on Bloomberg Originals, and on YouTube. Meantime, catch us tomorrow, same time, same place. Have a good afternoon, everyone.
All right, stick with us. Some breaking news here on FedEx. Those earnings crossing the wire right now. The shares moving lower. When we come back after the break, we're going to try to get an explanation as to exactly what's going on over there at FedEx. Peter McNally over at Third Bridge going to be joining us in just a second, right here on The Close on Bloomberg. Second straight day of gains for the S&P 500, coming off of 7 straight weeks of gains. Will that extend to an 8th, maybe a 9th, or maybe even beyond? Well, at least for right now, it appears that answer just might be yes. We know the economic fundamentals appear to be there. The corporate fundamentals appear to be there. And now some of the technical levels also appear to be there. You take a look at the momentum indicators on the S&P 500, and there is a clear trend line up. Now, of course, that could change in a flash should there be some sort of exogenous shock. But for right now, I'm not sure there's going to be. Remember, this is typically a lower volume week, and next week will probably be even lower volume than that with the big holiday season and a lot of traders away from their desk here. So this may be the price action that you get for the rest of the year and maybe not see a meaningful pivot one way or another until we get into 2024. You take a look at the Magnificent Seven. Yeah, they were higher on the day, but that's nothing compared to what we saw out of some of those cyclical names and those rate-sensitive names. The KBW Regional Banking Index up 1% on the day. Materials up 1% on the day. Even meme stocks in Carvana and GameStop, a 3% gain here for that index as a whole. You go through any other rate-sensitive sectors, you're also going to see similar gains here on the day, as we did get a bit of stabilization in those those rates. Now, they were still to the downside on a daily basis by just about 1 basis point or so. But again, we know where we've been. We're talking about a 10-year yield now down a full percentage point from where it was just about a month and a half ago. Similar for other parts of the curve. Weakness in the dollar also aiding the bullish narrative in markets right now. And the VIX, which has been dormant, well, pretty much all year long. No change today, right around 12.5. Scarlett?
All right. And of course, we're keeping an eye on what's happening in the after hours trade because FedEx did report earnings and revenue for the second quarter basically met the average analyst estimate. And we are looking at the stock falling in extended trading once again. So let's get some more details on this. And we turn now to Third Bridge Global Head of Industrials, Materials and Energy Analysis, Peter McNally. Peter, good to speak with you. I want to get from you your take on what's going on here with FedEx, because we knew that lower sales was going to be a theme for the quarter that ended. And when you look at the reaction in the market today, it's pretty disappointing, even as FedEx has reaffirmed its full year forecast.
Well, I think if we take a step back here, I mean, this is a stock that's up 70% year to date. And expectations of economic growth have been building for some time, although FedEx has been very clear that their forecasts do not expect, really any material improvement in demand. FedEx is about their own cost cutting. And really, the easy part of the cost cutting has been done so far. This quarterly result, at least, the first look here, looks a little bit light for sure on the margins. But so without the extra uplift from demand, things came in a little bit light.
I'm looking at the express business, which is the biggest part of FedEx's business, and revenue there missing the average analyst estimate, $10.25 billion. Analysts were looking for $10.4 billion. What does that tell you about pricing power, about the demand that they are seeing for the most expensive form of shipping?
Well, look, this is an industry that had to add a lot of capacity in post-COVID as things picked up, and we're dealing with the other side of that, at this point. I think one of the key pushbacks on FedEx last year was their discipline in capital spending, and they've had to cut that back. So right now, I think we're dealing with the after effects of that. And from what we've seen so far, FedEx is keeping with that, but there's still excess capacity in the system.
What's sort of the longer term growth story here? We're talking about new leadership that's, had a little bit of time to try to figure things out and make some decisions. There's been a lot of talk about some of the cost cutting efforts here. What do you think, ends up being the pitch that he can make to investors about the long term growth story for this company?
It's really about two things, right? It's technology and e-commerce. And are they making the right investments in technology, which was something that FedEx, frankly, struggled with? Can they maintain discipline and cost, whether it's, in labor or air? But look, e-commerce is a growth business. There's no, denying it. We pulled forward a lot of demand during the pandemic, which benefited FedEx. But then they started struggling with all that growth, and they shifted to adding capacity for it. But now it's actually making smart investments in technology to capture the future of e-commerce. I think that's the long-term pitch that FedEx is giving people. In the near term, it's about these cost-cutting initiatives, the DRIVE program that they've, initiated under this new leadership.
Yeah.
But, that's pretty much the story.
Yeah, and I'm curious, too, whether there is an opportunity for them to kind of reset here. If we are seeing some softness in, just basically the flow of consumer goods, if you will, does this give them an opportunity to maybe deal with some of those issues? Because they almost was the flip side effect of this, a couple of years ago when we were buying everything, and FedEx, and for that matter, their peers were just so overwhelmed by it. I know we don't traditionally think of them in the last mile sense. We don't necessarily think of them in some of the logistics sense that we think of in Amazon, but is there a way where they can sort of improve themselves enough where there is really no second option?
Look, there certainly is. 3 months ago, the company tempered their revenue guidance, for the year for the macro sense. They're not expecting any material increase in demand here. So they do have this opportunity to catch their breath. At the same time, there have been opportunities in gaining share, whether it's in the last mile or in the whole network system. So, if there was a time for FedEx to be fixing itself, I think now is a pretty good time. It does not look like we're heading into a recession, and they're being a bit more cautious on how they spend and what they spend things on. So I think it's a pretty good backdrop for FedEx. And then if the economy does start to recover, or their part of the economy does start to recover, these investments should pay off in the long term. But it is something that investors have questioned over the last couple of years: is have they been effective in investing in their business?
Right. And I like what you said earlier about we have to keep in mind the gains that FedEx has seen this year, up more than 60% through the close today. That was driven by cost cuts, excitement over cost reductions. How much more can cost reductions drive that stock?
Well, our experts are a little suspicious on this, that the easy parts of this were done already. I don't think we're getting any kind of update on extra savings from the Drive program. Mm-hmm. What they've needed to do in labor has been done, and now it's coming down to the harder part and getting more efficient in that network, and that's going to take time. So as we said, the easy part of the cost cuts have been done, and it remains to be seen, at least according to our experts that we've been talking to on this, that they can do that any further.
I am curious about whether there is an international story here. We know that they've had, well, let's just say a little bit of a spotty record in some of the expansion overseas, particularly in Europe. But this is still, at least as a percentage of revenue, still a relatively small portion of the business. Does that matter to you? Can they be primarily just a domestic shipper?
Well, like long term, it is going to be important, for them and all their competitors. But DHL has become a stronger player. Over time. The Asian economies, or particularly in China, have been weaker. But I think here in the near term, I don't think it's a big focus for FedEx, that there's enough to do here in what's been a pretty strong economy.
All right, Peter, always great to catch up with you, and always appreciate you taking time for us right here in the heart of earnings. Peter McNally over at Third Bridge, helping us break down those results we got out of FedEx. So shares down 7% here in after hours trading. All right, coming up a little bit later on the program, our next up segment, we're going to talk to the CEO of StoreCash about his app's quest to expand cashback bonuses to those in underrepresented communities. This is about banking for the unbanked, and it is one of the rising stars here in the small business sector. That conversation coming up in a bit, right here on The Close. This is Bloomberg.
Amazon is in talks with Diamond Sports Group and some of its creditors to invest in the bankrupt regional sports network and strike a deal for streaming rights. Let's unpack all the details with Bloomberg News' Amazon reporter Spencer Soper. And Spencer, it's important to note that this is still ongoing. There's nothing definitive at the moment here when it comes to Amazon and Diamond Sports, but it feels like this is a backdoor way for Amazon to get more live sports streaming rights. The question is, does it get it on the cheap?
Yeah, that's a good question. And so the Diamond Sports has a lot that Amazon wants. It's got broad geographic diversity. It broadcasts games from 40 teams. This is Major League Baseball, NHL, NBA. You've got teams like the Los Angeles Angels. You've got Milwaukee Brewers. In big markets. So definitely something Amazon's interested in, and diversifying it beyond the NFL that they've been streaming for a long time, but a lot of complications because it is in a bankruptcy proceeding.
We'll talk a little bit about some of those complications. I mean, Amazon obviously has deep pockets. It can do what it wants, but this doesn't look like it's just going to be that simple of cutting a check and walking away.
Yeah, exactly. And so there's a lot more stakeholders involved beyond just Amazon and Diamond Sports. But like you say, Amazon has deep pockets, and so I'm sure that the debt holders in this bankruptcy are going to pay attention and listen. And they just want to know. There's some plan that's moving ahead now where the lead debt holders will get paid several $100 million. And so they just want to see, okay, is Amazon bringing something sweeter to the table? And in all likelihood, Amazon could definitely do that. The question is, do they see the value of doing that? Right. And of course, Amazon's interested in the advertising part of the equation here. What can you tell us about how Amazon is experimenting with advertising on the live sports streaming that's different from what Diamond Sports is doing right now? Yeah, so if you think about, watching a game on TV, you generally see, obviously see a lot of advertisements, but it's just that kind of like billboard brand awareness type of advertisement where it's really tough to determine, okay, how is this influencing shopper behavior? Those brands can do some behind the scenes stuff to try to calculate that. But what Amazon's doing, if you watch their NFL streaming, they've actually got QR codes appearing on the screen. So you'll see an advertisement for a product, and you could whip out your phone and scan that QR code and get right to either that brand's website or to the Amazon site to buy it. And so they want to show that direct connection between the advertisement you purchased through their streaming program and a customer transaction. And that's extremely valuable in the advertising space, and that's really what this kind of stuff is all about.
You know what's valuable to consumers, Spencer, is that when we click on that and we end up on Amazon's site and we start reading the reviews, to have some confidence that those reviews are A, accurate, and B, actually written by real people who bought the products. There's a story on the terminal, which I'm sure you're familiar with here, with, I guess, a lot of AI generating these types of reviews. Is that right?
Yeah, so this is one of the, a pretty good use case for generative AI. We hear so much about it. It's like, how is this going to affect our lives? And so what Amazon did over the summer, back in August, they started rolling this out. They have their own generative AI distilling, billions of customer reviews on millions of products into these little short summaries of maybe 2, 3, 4 sentences, just to try to give you the highlights of a product that might have tens of thousands, even more than 100,000 reviews. But it's as with anything, it's imperfect. And so sometimes, and some sellers in particular are worried that the AI kind of accentuates the negative and maybe omits some of the positive when you're distilling that many reviews.
Well, that's what I was surprised about.
Summary.
Because I always feel like always the concern is the opposite with these reviews, that they're always just very sort of flowery and, tells you this is the greatest thing ever, like the greatest shirt ever invented. And then you wear it on TV and you're like, I don't know. Spencer Soper, always wonderful to talk to you. Who covers Amazon for us, covering, of course, the Diamond Sports. Maybe that ends up being a deal, and this foray into AI that maybe just makes those reviews a little bit better. We do want to continue our conversation about AI, and after the break, we're going to talk about the stakes rising in the AI wars as tech giants like Alphabet and Microsoft battle it out for dominance in the year ahead. Jana Egger is going to be joining the CEO of the artificial intelligence company Neuralogix. This is Bloomberg. Romaine Bostic here with a look at how markets performed here on this Tuesday afternoon, December 19th, that rally that has now been 7 weeks in the making, looking to extend it for an eighth. The S&P 500 higher by about 0.6% here on the day, and just a little more than 20 points from reclaiming that record high. The Nasdaq 100 closed at a fresh record high. So too did the Dow Jones Industrial Average. And while the Russell 2000 and the rest of the small caps, mid caps, and everything in between have a long way to go in order to catch up with those big names, they have posted some meaningful outperformance, with the Russell 2000 now set to outperform the broader market for a fourth straight week. The dollar lower and yields in check. That was a big part of the catalyst in refueling the fuel that's been fueling this rally. Scarlett?
It's a lot of mentions of the word high and fueling.
Yeah.
There's a theme here.
I know. It's
All
like
right.
priming the pump.
Exactly. Let's shift gears now to AI, because a new report from Bloomberg highlights the threat AI may pose to minorities. We talked with 2 former NVIDIA employees who say that they warned CEO Jensen Huang of the consequences of AI on marginalized communities, but they were ignored. NVIDIA declined to comment on the specifics of this meeting, but the company says it continues to devote tremendous resources to ensuring that AI benefits everyone. Joining us now from San Francisco is the co-author of this story, Bloomberg's Sindhuja Rangarajan. Sindhuja, thank you so much for joining us. You write about this meeting that happened, and it happened a few years ago. Walk us through what happened there.
So Mashika Allgood and Alex Sato, they both were presidents of their Black employees group at NVIDIA, and they've been working on a presentation for a year about AI ethics, transparency, safety, sort of portending that NVIDIA is already like a really important central player in the space, and it's only going to grow as that. And as that happens, we should have frameworks and processes in place that sort of assess the risks of AI. And they worked on this presentation with colleagues from across the team. They present to their CEO and eventually felt that, the recommendations they made or that the company was not going to take this as seriously as they hoped they would, and they quit shortly after.
This is not a new issue. I mean, even prior to all the AI hype this year, Sindhuja, I'm sure you know, there were some high-profile exits at companies like Alphabet and a few others precisely over some of these issues. And I'm wondering why we've seen so much resistance, at least among certain companies, to be fair, so much resistance to, I guess, at least entertaining some of those concerns, if not necessarily acting on them.
Like you say, the tech industry in general has always had fewer underrepresented minorities. And in this new analysis that we did, we look at S&P 100 companies, a sample of 88 companies, and NVIDIA particularly ranked quite low on amongst these companies in the bottom 5 for underrepresented minorities, such as Black, Hispanic, Native Americans, et cetera, et cetera.
Yeah, so, Sindhuja, I just want to stop you there for 1 second, though, because a lot of those high-profile departures were folks from various minority groups, whether blacks or women, or et cetera, et cetera. So the fact is they had some of these people in the door. How do they expect to hire more talented people like that if they're not listening to the talented people that they already had on the payroll?
Correct. And, I think the points raised by my sources with NVIDIA was, if you don't listen to our inputs, then likely that, you're going to have blind spots in your final product. And there's research that sort of backs that up. And then, like you mentioned, there's a lot of anecdotal evidence of other minorities and other companies sort of also saying the same thing. If you don't take our input into account seriously, then there's a possibility that the final product may, have blind spots.
So as we started off with, this meeting happened a couple of years ago. Since then, NVIDIA has put some steps in place. Can you talk us through what the company did to address this?
Yes, I mean, first of all, I think NVIDIA's representation of minorities has definitely grown from 2020 to 2021. They also hired Nikki Pope, someone with great credentials, to lead their trustworthy AI project to make things safe and transparent. They've brought in more transparency to their models. They've released a product called Nemo Guardrails, which helps chatbots, on track. So they've done a bunch of things to address these issues and questions.
All right, Sindhuja, great to talk to you. Sindhuja Ragarajan wrote a great story on the Bloomberg terminal involving some of the departures that we've seen and really some of the concerns over at NVIDIA and a few other companies when it comes to artificial intelligence and the risk of bias and other factors here that some folks think needs to be addressed. We want to continue that conversation here on some of those potential risks and talk about where the technology is headed in the year ahead. Jana Egger is joining us right now. She's a pioneer in this industry. She's currently the CEO of the AI company Neuralogix and spent quite a few years at other tech companies, including Lycos, as well as some non-tech companies as well. But you were obviously in this space long before the media and the rest of the hype machine sort of took over. But I do want to go back to the question that I posed to Sindhuja and pose it to you, because even prior to this year, we had seen some high-profile departures, and we should point out that these departures were very prominent people in the AI industry, many of them from minority groups, many of them, once they quit or were forced out, made it clear that they had raised concerns about some of the input biases as well as what the outputs were, and at least their side of the story is they weren't listened to.
It's sad, and people should listen. And there's plenty of opportunity. People aren't taking it seriously, and we know what to do. These experts that have left know how to handle these problems too. I'm not saying we'll be perfect at it, but there's paths forward. You take even a simple thing like model cards. For explaining kind of the ingredients of the AI and what's going into it. And people aren't doing simple tactics.
And this is just mind-blowing to me for a couple of reasons. In finance, I mean, as you know, AI, machine learning, things like that have been in practice for years now, really decades, or some form of it in decades. And everyone on Wall Street knows that if you put garbage into that spreadsheet, you're going to get garbage on the other side out. And your job is at risk if you do that, because at the end of the day, there's people betting, making financial bets based on what your outputs are. I don't understand why there isn't that same level of risk right now with some of these other companies. Is it not there?
There is that risk, but they have this strange belief that if we put more garbage in magically, this is what's happened, right? With deep learning is they say, no, but more data, that will solve the problem.
Okay.
And that's what they get caught up in thinking, and some of it has been has worked, right? We put more data in, and we started understanding images better. But we
isn't
didn't
it
really
like I don't know what the exact phrase of that graph is, where you start to get diminishing returns the more data you put into it, right?
Exactly.
Yeah.
And if the data is not the right data,
Yeah.
that's the other thing. This is why I'm actually a proponent of the regulations. People say, oh, these regulations are bad. I'm like, no, these regulations help people understand their data. They make them accountable for understanding their data. And so I'm pro regulation.
Do the regulations address something like the quality of the data that's being input or put in? Sorry, I don't know the verb for this. These are made-up words that we're just starting to use in 2023. But do the regulations address that, or are they still too pie in the sky?
I think there's some of both. So I think in Europe, you have more that are actually focused on the data. So what is this data? How did you get to it? What's it being used for? I think in the US, we're focused a little bit more on the outcome, and both are good, right? And so I think if we can watch and learn from each other, we're going to see what can happen. But just that focus on the data and getting people to understand the data that they have is absolutely critical. And it's what people are warning people about. If you put that in, it's exactly what you said. Put garbage in, you're going to get garbage out.
So what have we seen from the usage, the adoption of ChatGPT in terms of the data that's going into it and the outcome, the product that does come out?
So my favorite part about that is I think what people are seeing is that smaller, more focused data sets are actually working better. So it is kind of getting to your point about, hey, just this magnitude of data isn't going to be what's helping. If you actually get the smaller, focused on the subject area that I'm interested in, healthcare, for example, and getting something that's subset of that, not the entire internet, then that actually does help. So that's one of the things that I'm excited about. I still think there's too many people that think that this generality of the data is going to find the answer. If I search for everything, the answer is going to be in there somewhere, and it just doesn't work that way.
I am curious, for all the hype around ChatGPT and some of the other competitors, which look like they have staying power, there have been a few AI models, whatever products, if you will, that have already sort of gone by the wayside, or at least are certainly in decline here. Talk a little bit about those and sort of what sort of led them to, if not fail, at least to not gain traction.
So mostly the ones that have failed just gave bad results. So it's kind of like what you said. It was that survival of the financial model that, people said, well, I don't believe in this, or it was easily disprovable. And so you have some of that that's happening. I think we're still at an imbalance because people are still playing and getting some kind of fun results. And so, we're still on that hype curve, but I think people are still starting to realize, oh, we need to focus on our data. We need this. We need people that understand how to apply these models and use them in practice.
And it was fun, Scarlett. I mean, I don't know if you ever shopped for like a vacation or something using the chatbots or anything.
I have not used a chatbot at all.
Yeah,
I
it was
go
okay.
near those
I mean,
chatbots.
just be careful you don't end up in like Paris, Texas instead of Paris, France.
Exactly.
But overall, it was decent.
I'm staying far away from that. As you look at to 2024, I'm curious to hear what you think we're going to be discussing, what specific concerns we're going to be discussing about AI in the back half of the year, when the companies that we talk to, the companies that we talk about, tend to say that's when the payoff will really come for the products that they're making.
I'm afraid what we're going to be talking about in the back half of the year is how much money people spent and got no benefit from it. There's not an
Companies
ROI.
or companies?
Companies. You know, they're going to pour a lot of money into this and not be ready. They haven't structured their organizations. They haven't looked into the data. They haven't really understand what algorithms. Everybody's talking about these LLMs, and I look at them and say, are you sure you need a language model? Is the problem you're solving a language model? And so people aren't asking those questions. They're just jumping on.
All right, and of course they're just jumping on. What kind of requests are they making of these large language models that can't be answered right now? I mean, I think this is an important point because every company that we hear from during earnings season, Romain, they're all talking about the investments that they're going to make and the promise that these hold.
Yeah, I think there something I'll pull out is, ChatGPT has been talked about a lot, but Q-Star hasn't been talked about as much.
Yeah.
Q-Star.
Yes. It's a lot to learn, and not to be confused with R-Star, which is totally different.
So Q-Star is very different. It's not a language model. It's a way of searching, basically, looking for information in a new way. And I think the combination of those two, the language model plus the way of searching, is really going to show something different.
Yeah.
And so that's where I think people will go too far down one path without considering multiple or a combined path. Think about an orchestra rather than a single instrument.
Well said. All right, Jana, really appreciate your joining us. Jana Eggers, CEO of Neurologics.
All right, stick with us. Coming up after the break here, we're going to have our latest installment of our Next Up series. Derek Rutherford is going to be joining us. He's the CEO of a company called StoreCash. It's an app that helps the unbanked get banked. We'll explain after the break, right here on Bloomberg. Welcome back to The Close. It's time now for our Next Up segment, where we highlight the entrepreneurs and trendsetters moving the needle in the markets, technology, as well as the venture capital space. As the holiday season starts to wrap up here, consumers are still looking for new ways to make the most of their purchases, and brands, they're offering more incentives to keep the cash rolling in. That's why apps like StoreCash are teaming up with thousands of food, travel, and entertainment companies to offer users cash-back incentives when they spend. I'm pleased to say that the CEO of this startup is joining us right now. Derek Rutherford is a founder and CEO of StoreCash. I'm pleased to have you here on the program. Just kind of explain to us how this works here, because my general understanding is, like in the past, when you go into a store, if there was some sort of rewards program or points program, you kind of had to wait to get the benefit from that, either through mail or maybe if you had a bank, something like that could be funneled into your bank account. What was the problem that StoreCash was trying to solve?
Yeah, it's great to be here. StoreCash is an app that allows you to save about 7 to 15% cash back at major retailers across the U.S. And the difference between us and our competitors are that we allow it to be instant. So it jumps instantly into your StoreCash account. You can use it instantly on your next purchase or anywhere contactless payments are accepted.
Give us a sense here when you talk about the competitors. Who else is doing this?
So there's some major competitors like Rakuten, Dash, but the difference between us and them is that we allow you to pay with a QR code or a barcode, and that allows you to kind of evade those normal rails with MasterCard and Visa, and that 3% that you normally would pay through those rails actually go back to you. Along with that, we've negotiated percentages with a lot of these major retailers. So you would actually see about 2 or 3x more paying with StoreCash than you will with our competitors.
I want to go back to what Romain was talking about, which is the problem that you're trying to solve, because the origin story of StoreCash is fascinating, and it has to do with your nephew who was under 18 at the time needing some money. Can you walk us through what happened?
Yeah. So my nephew Will, I was trying to send him money, and I later found out he was a teen at the time, so he not only doesn't have any money, but there was really no way to actually send him money. So I wanted to make this platform an easy way, not just to send him funds, but also for him to help save money too. So I started kind of looking into the data and seeing that there's over 200 million Americans that are living paycheck to paycheck. I wanted to find a way to be kind of like an acorn, but instead of rounding up to the nearest, I wanted to make it to where they could still use, still spend the way they've normally been spending, but allow for that retailer to help them save.
Right, and by getting the cash back, they can then use that to apply to future purchases as well. How are you then safeguarding against fraud or stolen identity or anything where the money that your customers have earned back don't get taken by someone else?
Yeah. So we have a leader in the security space. We stole him from one of the biggest banks in the U.S., and he also worked at one of the biggest fintech apps in the U.S., and he's head of our security. So we did this kind of early on, realizing, fintech, and especially when it comes to technology, fraud is very important. So we, got the best guy in the space, and now he's on the StoreCash team.
Well, you say you stole him from a big bank. I mean, how has hiring been going overall? Have you had an opportunity to expand in this environment?
Yeah, so we're going to be expanding our team because we just gotten to 43 North. It's an accelerator in Buffalo, New York. We beat out about 1,000 teams to make it to the top 5, and we got $1 million investment from them. And we have a few million following on with that, and that will allow us to do a few key hires that we need, and also get the experts in the space for a few of the additional things that we want to expand out to when it comes to marketing and things like that.
What type of partnerships are you targeting? You mentioned some of the stores that already are sort of part of this program here, but as you expand that universe here, where do you want to go? And are you in negotiations with anyone right now?
Yeah. So right now we have like the H&M, Subway, PetSmart. We want to expand into cell phone companies and allow you to use your savings and cut down your cell phone bill and things like that. We've noticed that a lot of our users and where we focus in the underrepresented community, we want to, they're telling us the way they're using these savings is through paying their cell phone bill and things like that. So we want to make those things a little bit more direct on the platform so that we can allow for it to be easier for these things to happen and for these users to make their daily lives a little bit easier.
Yeah, frictionless, basically. So, Darius, you mentioned that the customers can save money. Are you paying any interest? Are they able to accrue any interest?
So not yet, but we are looking into that. We want to look into allowing them to not only do that, but also build their credit while spending money at these retailers and things like that.
All right, Darius, this is very illuminating here, and I'm glad also you brought up the folks over at 43 North who are doing a great job here with that program. Of course, you were one of the winners of the 2023 competition here, and we should check in with you sometime next year, see how it's going. Darius Relaford there, the CEO of StoreCash, here for our Next Up segment. All right, stick around because next up, we're going to tell you what to watch for tomorrow right here on The Close on Bloomberg. All right, wrapping up this Tuesday afternoon, a push ahead to what markets will have their eye on over the next 24 hours. And we're going to start off over in the United Kingdom.
Yeah, inflation numbers come out here. And when you look at the core numbers, 5.6% increase.
Yeah.
They're far, far away from 2%.
I know. We're hanging up a mission accomplished banner here in the U.S., but not necessarily going to be able to do that over in the U.K. Those numbers will break overnight. And when you come in the morning here at about 10 a.m. New York time, we're actually going to get U.S. existing home sales.
And this is the biggest part of the U.S. housing market, right? Homes that are already standing and the change in hand of those homes. We did see that new home starts rose to a 6-month high. So perhaps the falling mortgage rate is going to encourage people to buy more existing homes, but you need people to put their home up for sale first.
I always love it that they call it existing homes instead of used homes, because that sounds a little bit better here. We're going to get another Treasury auction tomorrow. We know a lot of the auctions we've had as of late have been a little uneven.
Yeah, but and the 20-year is a weird one, right, in terms of the tenor, because the rate is higher than even for the 30-year and the 10-year, but at 4.2%, it's going to be a real test of demand for Treasuries given where we are in this rate cycle.
And I'm interested to see if the 20-year picks up traction. And we've talked to a lot of investors and traders who've really said that the 20-year is probably a little bit more indicative of where the benchmark should be than the 10-year. We're also going to get earnings before the bell. General Mills is going to report, and after the bell, a big one.
Yeah, Micron, the memory chip maker, the stock is up more than 60% so far this year. So the big question is, have they seen the worst of the memory chip glut?
Tune in tomorrow. Scarlett and I will be here to break down the earnings out of Micron tomorrow after the bell. In the meantime, right here in the U.S., Balance of Power coming up next for all your political news. Have a great evening. This is Bloomberg.